Everyone's talking about Kohl's. This is wild. Open door in Kohl's. We're in squeeze season, baby. Time to squeeze those hedgies. Burn, hedgie, burn. I'm just kidding. Don't buy Kohl's. Nobody buy Kohl's. I'm sure it's gonna go. Let's see. Let's fucking see. Weren't these guys gonna go bankrupt? This is like JCPenney for Ackman. Repple kind of seems oversold, but if the bakers are bailing, then I would do whatever the bakers do. If the bakers bail, it might be just oversold anyway, but let's look at Kohl's first. GameStop 2. Return of the Stop. Return of the Kitty. CEO of Kohl's is 71. He's sitting here like, what the fuck? Bro, I don't know where I am, bro. Oh my god. Yeah. Okay, so they have $1 billion in debt. It's not that bad. 1.6 in debt. I mean, they're profitable. This might have just been like open. It might have just been a cheap stock that people kind of were sleeping on. Cash flow? It's probably just declining to zero, but so it's at 2 billion. I mean, honestly, it might be finally MOAS. I don't want to buy this garbage, but this could be it. Everybody, tell your mama, tell your grandma. Kohl's. Yes, that Kohl's. Make sure you click subscribe. I'm almost at 100,000 subscribers. When I get 100,000, I get to YouTube plaque. I get the plaque on my wall. I get the plaque on my wall. Like a rapper. Platinum plaques. So you got a lot of little trade ideas here. You could try to buy Kohl's for the squeeze. You know, Kohl's could go to 40 or 50 in the squeeze and then come back down. Just make sure you sell it at 40 or 50. You could buy Repple or EPL below cash value. I don't know if I want to do any of these trades. Certainly feels like many people are bailing on Repple. If you believe Repple has some activity, they have 400 in cash. It's trading at 200. I'd be in the doghouse a while. I mean, when we looked at the Repple data yesterday, I mean, these guys can't do a fucking single arm comparator instead of a monotherapy comparator. You know, it's just like pathetic. my drug works with this other drug, but only with this other drug. The fuck kind of drug is that? They want to be like Yervoy, and Yervoy should have never gotten approved, in my opinion. We're in a kind of environment where I think it, well, if Kohl squeezes sustainably, it'll tell you something about where people are at. Yeah, sorry, Austin. Repl is a bit of a different story. Repl is kind of like, feels like you probably, can buy it and just get a little bit of a rally. Oh, good, Austin. I'm glad to hear that. I was worried about you. Well, there goes Kohl's above 20 for a second. I thought Replimune had like monotherapy activity. I don't know. It might be a buy. I hate to chase the shit. I'm not chasing it really, but by a teeny tiny amount. It's just that they have. They just have too much cash. And the drug does kind of work. No, don't buy it just because I'm buying it. Okay, Kohl's is fading. This is a bearish sign because, in fact, you might want to short Kohl's. Whatever people thought it was worth $8, the squeeze is fading. Ooh, I missed the short. Ah, I just missed it. It's collapsing now. But I might get filled. Ah, inshallah, I got filled. But yeah, Kohl's looks like Cinderella. Cinderella at midnight. Who owns this sucker? KSS, Equity, HDS on your favorite terminal, whether that's Godel or Bloomberg, the same HDS pulls up the holders list. We got BlackRock, Vanguard, UBS, Susquehanna, Dimensional, American Century, State Street, Allianz, Capital Fund, Balyasny, Goldman, Invesco, T. Rowe, Citadel, LSV. Very wide distributed shareholder base. Some quants, some long onlys, some mutual funds, some hedge. Feels like it ain't gonna make it though. Let's press this shit. Press this shit. How many department stores can Wall Street Bets afford? How many old retailers can Wall Street Bets afford? I'm shorting this. This looks. Look at the breakdown. Okay, look at the chart. The breakdown is so obvious. This is the trashy cat pattern. This you can see is her head. This is the forehead, the trashy cat. Oh, Rebel. Oh, wow. There you go. maybe get $4 on Ripple. Yeah, right? I'll give you all the TA lessons. Ooh, I love this Kohl's. We're going down, down, baby. How many red candles in there are? 1, 2, 3, 4, 5, 6. If there's 6 red candles in a row, that means absolutely nothing. Now notice the price is declining while the volume is declining. That also means absolutely nothing. Yeah, sure. Same as yesterday. I think the drug will stay on the market. That's still my thesis. Well, you know something I don't? My resistance. Oh no, my resistance. It's real, bro. Technical analysis is real. It's so real. I know it's real. Ah, new generation of baggies. Where all the bad baggies at? It's like a jungle in this habitat. I like Sarepta, but you know, I was talking to my Discord yesterday. Like, yeah, you don't have to overthink too many stocks. Like, I'll give you an example. So this is a really good speech, I think. So this is your attribution, okay? Attribution. What does that mean? Well, I'll give you mine for a second, okay? This account, I made 40% on Immune, okay? 40, literally 40%. As you can see from the title, I'm still down a little bit, but let's see how much real time I'm at. 15% at the moment. It moves very rapidly. So I'm down 15%. Immune is obviously, you know, great. It was up 40%. But my biggest loser is D-Wave, which has cost me 40%. And then, you know, I have Sarepta, which has cost me like 8%. And then I have other ones like, I don't know, IonQ is maybe 30% or something like that. I don't have the exact numbers on me. Then I had some big winners, like I had that weird SBET. I made a lot of money on SBET somehow. I just timed that really well. So anyway, here's the point. You're gonna have good trades, hopefully due to skill, and hopefully your bad trades are due to either, you know, they're gonna be, hopefully they're just bad luck, which gets distributed, and your skill shines. You have more skill success than you have bad luck. But to be clear, you will have bad luck, and you will have bad trades too. So you're gonna have like a combination of your alpha and, you know, in your wins and losses, hopefully you have, you know, I don't know, in a given year, at least on big trades, you have 5 big wins and 2 big losses, and this is good alpha, right? And then you have sort of I don't know what we can do for luck, but we'll call it lambda. And lambda, you're going to have luck as well. And you might get stacked with L's just because of bad luck, not because of skill. Now, differentiating the two is not easy. But you can say that something like Sarepta, look, this was a really unprecedented thing, right? This was fucking nuts. You could have argued you saw it coming all along, but it's a pretty nutty situation. And if the worst thing that happens is you lose 5% of your account or 10% of your account on Sarepta, there's worse things. That's fine. And it doesn't really matter whether you put it in the bad luck column or the bad alpha column. It's an L either way. But your luck is going to be evenly distributed over time. Generally speaking, this should equal this. You don't know when, though. Good luck will come sometimes, bad luck will come sometimes. But you have to be able to survive, the bad luck. And you have to be able to survive the bad decisions. Either way, you're going to have to survive either one of them. And that means you have to have some good trades. But the point I'm making is that, how much of your account are you willing to lose in something? If you're willing to lose 100% of your account in a trade, you better be certain. And at some point, you might say, I'm pulling the plug. I've lost 20% of my money in Sarepta or whatever it is. I'm out. That's perfectly fine. And it's a lot easier to make back. Let's say you lost 20% of your account in Sarepta. Well, you don't have to make it all back. And let's say you want to still be long it. Well, let's say you have a 10% position and it doubles. Well, you'll still have lost 10% of your account, but that's a lot better than 20. And you can make money in other stocks, like have another big binary coming up, which will hopefully be profitable. But again, it can go in the bad luck column. So there's no real reason to sort of understand or expect like any given, day what's going to happen in the market. You can't control that necessarily, but you can control the decisions you make and, how much you're willing to lose in something. On a long, you can control that easily. And the question is, how unprecedented of a situation? And to me, what I've said was, well, it's hard for me to see a stock go from 10 billion market cap with a lot of revenue, a lot of approved drugs to a 1 billion market cap. That's exactly what happened with Sarepta. And if something's really unprecedented, I'm willing to take a big attribution hit. As you can see, the whole quantum thing is really unprecedented. I'd be up 70% this year if I never met quantum, right? I'd be up 140% if I went long quantum. But woulda, coulda, shoulda, if I had boobs, I'd be a woman. It doesn't help me. The point is that, I went short these stocks and I kept shorting them because I felt it was, and I still believe, it's an unprecedented situation. Now, will I ever make money from quantum? Probably not. And here's the most important thing I'm about to tell you. That's okay. Why? Well, this distribution curve, everyone has one. Steve Cohen, Jim Simons, you, me. This distribution is going to exist for everyone. You will have losers. Every single person on this planet who trades will have losers. The question is, what do you do about it? Will these losers wipe you out? And will these gainers outweigh your losers? But you will have losers. There's no trader that doesn't have losers. And it's just a question of, am I willing to lose on a super unprecedented situation? Yes. The quantum computing rally is insane. It is very unprecedented. These are the most actively traded stocks day to day, right? That's weird. That's totally unprecedented. But what would be weird, what would be bad, so this is sort of like, no loss is good, but I'm okay having unprecedented shit being my losses. Why? Well, what if I went right now to the SPY 0-day 629 calls? Or make it the 650 calls, or whatever it is. That's a coin flip. But if I put my whole account in that and I had a negative 99% attribution I guess that would be down here, on a random 0 DDE flip, well, that doesn't make any fucking sense. That's not an unprecedented situation. That's just a gamble. So, if you're willing to lose money on truly unprecedented situations, Sarepta has taken hit after hit after hit, very weird and unlikely situation, you're willing to take, 8 to 10% loss on it or more, depending on your risk tolerance. But don't take a 90% loss on a SPY bet that you don't, you're just gambling on. That's not unprecedented. The SPY might go up 1% today, it might go down 1% today. There's no rhyme or reason. But something like Kohl's, that's pretty pretty unprecedented. It's a lot like GameStop. It's like a mini GameStop. But again, your position sizing and how much risk you take and how much attribution you're putting on the line. How much money are you putting on the line? That's the key question. Yeah, so I would just keep shorting Kohl's until it goes back to 10. This is just a massive psyop. And this will bankrupt Wall Street bets out of quantum computing too. Poor guys. Well, anyway, those 2 trades made me a ton of money. Thank you guys. Hopefully you made some money too. I started this video down 19, so now I'm how we doing here? Pretty wild. Here we go, down 8. Let's go. Yeah, Finnicus knows. We always keeping it real. Now the question you might have is the trashy formation complete here? So really ugly. Damn, that's crazy, huh? I'm in the news again. Pharma bro, Shkreli, this and that. Man, keep my name out your mouth, man. Just shut your mouth, man. Okay, I'm covering Kohl's. It's probably gonna keep going down. I just happy to book a profit and move on.
I'm from Brooklyn. You may not realize that. Let's go.
I'm about to end this man's whole career.
What career? What career? Down 3%. That's it. Let's go. You can always make it back. Just gotta stay in the game. Live to play another day. Ask yourself, am I taking unprecedented risk in this unprecedented situation? Or am I just taking unprecedented risk because I'm an idiot? Sometimes it's because you're an idiot. Who's the bad baggy now? I mean, QUBT is 90% downside, bro. Like this isn't a drill. Okay, I just featured the launch, guys. So you're gonna love it. You're gonna absolutely love it. Plenty of people who finance data centers right now. It's the hottest thing.
Yeah, I don't care for Crocs. No, it's normal to have losses. Like, I don't think I'll recover from Quantum's losses to make them gains, but if I can lessen the loss, I'm happy because again, you're gonna have gains. I had other gains and other things. I don't need to make a gain in every fucking trade I make. You know, I think you have to get out of that mindset because it's foolish. You know, there's just nobody that's that good. You just want to make your losses manageable, and you want to make losses when something weird happened. You know, something really got out of control that you couldn't control, or you know, the market was just wild. Not just for any ordinary shit. You shouldn't be sad about losses. You know, they're gonna happen. It's just a question about how did they happen? What'd you do? Did you make too big of a position that you couldn't handle or understand, or things like that? But yeah, I'm almost up, which you know again would might surprise some, but again, you know, Immune helped a lot, and my next binary will help quite a bit too, I think. Yeah, I don't like that phrase, no crying in the casino, because, I mean, in some ways we're gambling, but in other ways, I mean, there is an intelligent way to do it. I mean, if you are flipping coins, then I don't know what to tell you. But, you know, if you're flipping a coin with your whole portfolio, that's just, you're asking for it. There's about 6 more binaries coming. We missed REPL. REPL was the one we were looking at yesterday. Couldn't make heads or tails of it. Obviously, in hindsight, should have been shorted, but that's hindsight. Oh, crap. Woke up with the most red eye I've had in a long time. One of my cats must have. I might want to rehome them, but I love those little munchkins. Should I rehome them?
Minsky moment. We're overdue, man. The Bears need to win some too. Bulls gotta win some, Bears gotta win some. Can't just be Bulls winning all the time. Weird.
He died like a dog.
Dominance this cycle. Give me a break. I love how crypto people think there are cycles. What fucking cycle? What the fuck are you talking about? Some shit you're imagining. It's happened a few times. It's gonna happen all the time. Just me with that shit. The having. It drives everything. When I see something repeat, I assume it'll repeat forever. Now I call that the cycle. Just like the business cycle, except I made it up. Well, there is something called the business cycle and the credit cycle, but those are real things. Humans love to assign patterns to behavior that's not even cyclical. And yeah, just because Dalio says it doesn't mean I won't shit on Dalio too. Dalio doesn't work at Bridgewater anymore. Wonder why. Some of you guys want me to go back to prison. I can see that. I can tell. Want me to put hands. I'm going to put hands on somebody and send me back in. Nah, I ain't doing that. Not for some bullshit with you. I ain't doing that for you. Not worth it. You will respect me one way or another. Okay? One way or another, you're gonna respect me. Just don't make it that way, man. I will force you to respect me. I learned various ways to do that when I did my time. You will respect me. Yeah, you're gonna respect me. Believe that. You might be on your knees, but you're gonna respect me. You might be bent over, but you're gonna respect me. One way or another. I don't give a fuck. Hold up. That's respect. That's simple respect. Apologize. Following video is from prison. It's very raw. Don't listen if you don't want to hear some crazy shit. But this is what it's like in jail. All right.
First of all, right, if he's a newcomer, right, I want him to suck my ass with jelly. It's what they call tossing salad. That's the slang word, tossing salad. It means sucking my ass, right? With jelly or without jelly. Some people use syrup. I prefer a guy to use jelly, right? I will reach my climate, right? I will automatically get hard, right? I will, come automatically if he's sucking my ass for about 10 minutes or longer, right? It's a sensation feeling, and it makes you feel real good. Most all gays do that, you know what I'm saying? Like guys to suck their ass. It's just like a pussy, right? But the only difference is it's not a pussy, right? It's clean, the person is decent, and the person know that that's an asshole, but in mind he's looking at it as a pussy because he's in prison. So toss my salad, let him eat me, and we straight. That's it.
Okay, that's the world I come from. Okay? That's the world I come from. You better fucking respect me. How you respect me? Oh, you gonna respect me. I'm gonna show you. In front of the whole prison, I'm gonna show you. They're gonna witness you respect me. Talk that shit. Your whole neighborhood, your whole family. Damn, he really respected him. Yeah, that was disgusting. He really made Chris respect. Man, I hope I don't have to respect like that. Don't make me do it. Don't make me do it. From your whole family, your parish, your community. Fucking make me do it, man. I've been known to do it. Just minding my business. Providing some information. And you come here and disrespect me. That's fine. Go ahead. But you're going to learn how to respect me. You will learn. Believe that. Are you gonna keep disrespecting me? You wanna keep disrespecting me? Tell you what. I'm shutting the studio down. Here, I'm closing the window. You don't want any more trades? Cool. I'll mind my own business. All good. I got work to do. Oh shit, I forgot I was streaming. What's up, guys? Allergies, cats. Yeah, I looked it open. It didn't seem like it was a good short. But I don't really understand the business plan or anything. I mean, you have to decide how much risk you want. It's very possible Sarepta goes to 0, so just keep that in mind. I don't think that'll happen, but oh. Yeah, I think all the bad news seems like it's baked in. Oh. I don't think it's possible either, Sally, but, you know, I didn't think a lot of things were possible. You just have to leave some room for doubt, even if it's 1%, you know. Yeah, Zach, just be conservative on Kelly bets for sure. Capper doesn't have anything, unfortunately. Yeah, it's hard to tell. They didn't do any studies of the drug by itself. There's a couple of pieces of data that were okay, but nothing really definitive. But if I had to guess whether the drug had some chance of working, I would say it does. There's some data that suggests it's all right. I don't know if it was ready for approval, but they wanted approval on their first study, basically. It's a little greedy. Vinay slapped the shit out of that man. Padufa came and went meme. They got a CRL. He slapped the shit out that man. Put hands on that man. Yeah, Loomer's getting a. She's trying to do equalize. I'm sorry. She's trying to equate Vinay and Vivek. It's like Indian. Pompous and arrogant doesn't listen to us whites. Pompous and arrogant doesn't listen to us whites. Fire him. You know what? She makes a good point.
China.
He's too Indian.
China.
You know, they'll say some racist thing like, he doesn't share our values.
China.
You know all these people are xenophobic, right? Just the name Vinay Prasad scares the shit out of some people who are like 75 white people. They're like, Vinay Prasad? What the fuck is that? Vinay Prasad should not be telling my son whether he can have a chance at living or dying. Vinay Prasad. And of course, look, he's as American as the rest of us, but that's how it works. A lot of times I wish my name wasn't Martin Shkreli and it was Martin Schwartz or Martin Stein, Martin Smith, Martin Schmidt, but I'm Martin Shkreli, and you know, it's better than being Muhammad Shkreli. That's just how people are, man. We live in a world. We live in a society, okay? We live in a society. If I was Martin Kennedy or Martin Rockefeller, shit is different. We live in a society. I mean, Kramer used to joke. He's like, Shkreli. He's like, you need to go on Wheel of Fortune and buy yourself a vowel. I died. So just change your name to Martin Stein or something. Yeah, he said, what did he say? He said, just do yourself a favor, change it to Martin Stern, or I forgot what it was. There's a name he picked. I forgot what it was, though. Not important. Oh, it might have been Stern. It might have been Stern. I don't remember. I really don't. I don't think it was Stern. I think it was.
Look at this guy. I'm gonna come.
I just love Howard Stern. I'd be down to change my name to Muhammad as a consequence of making a bad stock pick. But it's got to be a really big bet. I'm really sure on. I'm not just going to do that for nothing.
Are you even halal?
Sorry guys, I'm busy doing something. There's the Korean stock that owns PUBG. Kind of funny. Never traded it. I've always heard of it called Krafton. Never actually traded it myself. Some Korean stocks, as I do. Markets are up a little bit. Quantum's still down nicely. I think Nvidia's going to have a monster quarter because the H20 resumption, China resumption. But we all know that, I guess. It'll probably be bigger than we think. There's just so much money available for buying data centers and building data centers. You guys, if you heard the stuff I'm hearing, you'd be surprised. The demand is not slowing anytime soon. We might even want to buy CoreWeave. I mean, as expensive as it is, you know. You guys know about beef trends in Latin America? They're very robust right now. Rice prices have been dropping, I guess. Interesting.
Lockheed's down. 10%. Aye.
What they do though? They do though. Oh. Damn. Missiles and shit? Yo, Z. Yo, Big Z. Yo, Big Z. Come here, Bozo. What is this? Did you have your AirPods? Did you not hear me?
Downloading stuff, so just listen to something.
What if I need you? Can you make me a post on X? And it's gonna look like this, but you have to make like the GIFs. This won't be too hard. It basically be like a lot of VCs and CEOs ask me about gang life and corporate life. Here's a thread on all you need to know. It's like a little thread, but like the arrow, and it's like it would be like one, like. When you're in the corporate life, you're hanging up your flag. So you're not on active roster and you're not banging, generally.
Yeah.
If you're going to be in the corporate life, tell your OG or your GF, Godfather. You might not know that.
Godfather.
Yeah. Tell your GF or OG that you won't be banging temporarily, and that you have to go on the inactive roster. Okay? Next slide would be, next tweet, it's like thread, would be like, if you have to bang while you're working, try to do something that benefits the company because your board will be worried about a conflict of interest. Next slide. You could be like the geography and makeup.
If you want to like exactly like that, you can write it on Discord.
Yeah, write it up, but like get to pick the pictures out
Yeah.
and like all that shit.
I got some ideas.
You might need
Just give me like a couple minutes.
Yeah, take your time. It's no rush.
Sorry, like whenever I download stuff or like scrape stuff, I just put on like music or a podcast.
I understand,
Yeah.
but this isn't a fucking entertainment, place, so you can listen to fucking music all day, right? Fucking listening to music at work, bro. What the fuck, bro? I'm sorry, I'm listening to music. Man, get the fuck out of here with that shit. Let's go. I don't see how you could concentrate like that, man. It's crazy. This was crazy. Who you talking to? You don't know I did 5? Who the fuck you talking to? You don't know I did 5? I did 5 out of 7? How much you do? How much you do? Oh, you went to 4chan 5 times out of 7. That's what you did. Yeah, I bought a little REPL. I'll probably kick it out soon. Not that good of an idea. Yeah, I mean, it'll probably bounce in the next few days, and then I'll be gone like a thief in the night. I will not tolerate any shit talking in the chat. None. What's up, Katie? What's up, girl? What's good though? I like your pick. Damn, you fine. How do I talk to you online? Oh, yo, never mind. No matter of fact, I'll talk to you later.
You know who talk about me the most on the internet? Niggas. Niggas. You know what's worse than a nigga? Two of them.
Shout out to Kevin Gates. We thought about making a Shkreli ETF. Just for the lulz. Part-time. Yeah. I don't fuck with Kevin Gates. It's a fact. Guys in jail like Kevin Gates, though. Everybody a different opinion on him, though. Yo. Shorting my short ETF? You think my shorts are going to go up? Yeah, I just don't like trying to figure out what the FDA is going to do. Clearly, they should have done a fucking randomized study, and the randomized study they're doing is pretty ugly too. Just compare your stupid intratumoral shot to, compare it to Opdivo. And if you really think you need Opdivo to make it work, compare it to Opdivo without your intratumoral shot. The problem with that is your statistics might get all fucked. And you can't get approval in a 100-patient study. Oh no, wah! You might have to do an actual 500-600 patient study. You want to sneak one past Vinay? He's not doing that. I like clinical trial binaries. I hate FDA binaries. See, the old FDA before Vinay was about diversity, inclusion, equity. They basically looked at your drug. If you had a bad drug, they said, well, we need some diversification, Not every drug could work. blindsided. I can't believe they want controlled trial. What the fuck is this, man? Controlled trial? What? Evidence? Evidence? Man, I filed this whole approval for nothing. Just, you can't predict what the FDA is going to do on any given day. It's a tough part of the business. Straddle, I'm a little surprised at how low it got. That's why I went long. The straddle was the play. I mean, it was a true binary. It's a hit. It's a hit, Playboy. You guys want me to play something interesting while we sit here? Oh, damn. Bobby Schmurda, 100 Crips? What the fuck?
Hey, Richard famous. Paparazzi watching. Yeah, I try to tell him.
You get that snow bunny.
Everybody on there.
You got that thick John.
Yo, hold on, we gotta go to the trap. Come on, we gotta go to the trap. We gotta go to the trap.
What?
I hope it's a literal trap. I need to know. I'm looking for some of that Schmurda crack, man.
Yo, stop it, son.
Stop it. We're gonna take you to the main block.
All right.
We're gonna take you to the trap where it all started. Bro. We're gonna take you to... Hey, my son G used to pick you up, take me out of town when I was 14, you right? All right. John back then. I was selling 62s from every week, you right? We're gonna take you to the spot.
We cooking up over here.
Yo, bro.
How y'all doing?
Brooklyn vibes, actors.
Yo, Richard famous. Richard famous. Hey, Richard famous. Hey, Richard famous.
Okay. Yeah, this is the one I wanted to look at.
Entrepreneurs. We're one of the few handful of firms in the world that can consistently write billion-dollar plus checks across asset classes.
What made that group tick?
It's easy to have a culture when things are going well, but cultures are defined when things go wrong. At 6th Street, we're like, good, let's go. Let's face the tiger together.
All right, I don't know where to begin. 6th Street is so incredibly interesting in that it can do anything. It can go anywhere. It's extremely opportunistic, extremely flexible, open mandate. We'll talk a lot about the history and the different kinds of investing that you've done. But I think a fun place to begin would be for you to tell us about your Goldman days, and specifically the group of people that you were investing with back then, which I've heard described by you and others as sort of like the Navy SEALs or special forces of finance. Maybe describe that group in as much detail as you can and why it was so formative and impactful on you.
It was lucky that I even got into that group. I met a guy on an airplane. Basically, I was an international relations major at Penn. No finance history, anything. Got out of school, and I was basically working in the mailroom. Bond-only management firm called Fisher, Francis, Trees and Watts. And was punching books, and all my friends were, they all had jobs. Basically at Penn, I had 35 interviews. Didn't have a job offer out of college. That's why I ended up in the mailroom. I was always interested in companies. I just didn't know a lot about it because I didn't have a corporate finance background. And I was on an airplane coming back from Texas, my home, and I met a guy on an airplane, this guy by the name of Jody Lanassa, and I was just asking him a bunch of questions, and he was telling me, I think I've listened to a lot of your podcasts, and you're a very curious guy. I ask a lot of questions. My wife makes fun of me because I ask questions all the time.
By the way, on our first call, when I was trying to learn about you, it took a half hour to get me to ask you questions. Yeah, so I've been on the receiving end. I felt it.
I go to dinner sometimes. People say, well, you asked me 1,000 questions. I didn't get a chance to ask you. That's just how I am. So I was on the airplane, and this guy, Jody Lanassa, who had started in this group, and he was reading research reports, 1,000 miles per hour, literally just processing speeds I'd never even seen before. So I just started asking him questions about what are you doing and what's your group? And we just started talking on the airplane. He came from Wachtell, a principal investing group at Goldman that literally is highly flexible, could really do anything, which by the way is a predecessor to the group that I was ultimately in. Anyways, we ended up forming a relationship just because, what I learned is curious. The good thing about being curious is, you build relationships, you learn a lot, and it just creates opportunities. So anyways, he ended up getting me an interview, and I got into this group, which was, you know, ultimately became the special situations group at Goldman. And that group was the largest principal investing business at Goldman. It was the firm's balance sheet. At its peak, I think we were like $25 billion of the firm's balance sheet. And literally, our mandate was to basically, you could
Make
do
money.
anything, any theme, we could do different asset classes, different sectors, different geographies, different durations. So we could do stuff that were 2-3 year investment horizon or 10-year investment horizon, different return profiles. Some was 10% return stuff, some was 20%, 30% return profiles. Literally, we could do anything, but we couldn't lose money. We couldn't lose money. That was basically the thing. So what we learned at the time is this group, which, you know, I won't say the number, what we were while I was there, not just because there's a lot of super talented investors, but we were a substantial amount of Goldman's net income with a very small team for 10 plus years.
What made that group tick? Like, I'm curious about all aspects of it: the recruiting, the culture, the investing style, the low loss rate.
Is really the ability to unitize risk reward across different asset classes, geographies, sectors, return profiles, duration profiles, but literally take a real estate type investment, compare it to a U.S. real estate investment, compare it to a U.S. corporate loan, compare it to buying a company, compare it to starting a company, and we unitize risk units and return units. And we did that across a bunch of different sectors, a bunch of different geographies and asset classes. And just that skill of being able to do that, you constantly comparing relative risk units and return units, and it gives you the ability to find the best risk reward at that time. And the key principle there is that, and this is one of the things we learned at Goldman, and we learned this the hard way. Goldman was a bunch of fiefdoms of principal investing business. There were 10 fiefdoms, different partners running investing businesses, and none of them talked to each other. They all had their own balance sheets, never spoke to each other. So during 2001, 2002, a number of the businesses, a few of them lost a lot of money. Like, for example, we had in the US, like the business I was in, which is a US corporate investing business, was pretty negative on fiber builds. If you remember, like Exo Communications or Williams, remember all the fiber, which was overbuild, all that. There was another group at Goldman who were great investors, but they were all in on fiber. And even though we were literally one floor apart, one group lost a bunch of money and we were we didn't lose money. And after that, the firm basically said, you know what? Let's put all these disparate principal investing businesses. Again, we didn't have outside LPs. Put them all under one umbrella, and that ultimately became what was the Special Situations Group, which again became a substantial part of the firm's profitability.
Can you say more about this notion of unitizing risk and return, like the literal tactical way that happened?
So we think about the relationship of risk units and return units. So return units are easy. It's IRR, it's duration. Risk units, they're a lot hard. Risk units are a lot harder. If you think about sort of the two key variables of, let's say evaluating any company or security, you've basically got the cash flows, the volatility of the cash flows, so the risk of the cash flows, and growth. So the way we think about it, and again, this has been refined over 25 plus years, is our framework is basically we take three things. So first of all, what's the quality of the business? What's the quality of the sector? The second thing is, where do you sit in the capital structure? What we would say is your attachment points. And the last thing is documents. So we take that framework and we sort of run that framework through that across sectors, geographies, and that sort of, that's how we start to quantify risk units. So for example, if you take a consumer goods company that's let's say a buyout of a consumer goods company, and let's say a private equity firm buys it for a 20% return, and let's say they lever it 70%. You take a hyperscale data center that's got, let's say, a 15-year take or pay contract, with an investment grade counterparty, that's going to be a required lower return. So that'd be an example. If you have a geography, let's say, just as an extreme example, if you've got a 15%, let's say, structured equity investment for a company, let's say exact same company, exact same sector in Australia, if it were in Ukraine, you're probably going to demand higher than 15%. Let's say we're a minority equity investor in a company. And you've got literally the control party can literally do whatever they want. They can dilute you. They can put a bunch of debt ahead of you. That's one set of risk units. If you've got sort of traditional, hopefully good minority protections, that's another set of risk units. So we basically take all that We sort of do that across asset classes, sectors, geographies, durations. So some stuff like our capital, we can do stuff that some of our returns, 10 to 12% returns. Some of our stuff is 20, 25%, 2 to 3 times your money. And our whole view of the world is very dynamic. It's always changing. And what happens is with investors, and I think everyone thinks their baby's the prettiest. So if you're just a healthcare investor, you think your baby's the prettiest. You're just an energy investor, you think your baby's the prettiest. If you're just in Europe, you think Europe's only good. So we try to do is sort of step back from that, and then constantly, as we go through economic cycles, credit cycles, secular cycles, geopolitical changes, and we sort of think about things on a real-time basis. And what we do is 450 to 500 deals coming into Sixth Street every month. Typically, we have about 15 to 25 themes running through our firm at any one time. And the key is, and this is what we learned at Goldman, is that any theme that is good has a shelf life of somewhere between 12 months and 36 months, because ultimately there's a lot of smart people out there, and all of a sudden it's a really good theme.
Gets priced.
It comes in and it's a good theme, then it's a less good theme, then it comes a okay theme, then it comes a bad theme, and then it basically people are overcorrect and they start putting leverage on it, and then you have a correction. And our whole thing, and this is why we had the track record we had coming out of Goldman and do at Sixth Street, is that we try to see through that and never get caught in that dynamic where when a theme becomes less good, we migrate to other themes. So our average theme has a shelf life of a year to 3 years. So we're constantly, if you take our themes from 2025 and you go back to 2022, the 15 to 25 themes might be a little bit overlap, but most of them are different themes. And that's sort of why we always think of Sixth Street, like when we founded the firm, we said, we have to be a firm of entrepreneurs. Because if you think about what we're doing, we're constantly migrating to the best risk units and return units, obviously also trying to be a value-added partner to CEOs and management teams. So because the world's always changing, we have to be constantly coming up with new themes. And that's sort of what we learned at Goldman.
How did you recruit people into SSG? Was there any lesson on the on-ramp?
First of all, back then, it was the group to get into. It was the hardest group to get into. So we had our...
Even it sounds like Special Forces SSG.
Yeah, it was like when the Wall Street Journal called the group the Navy SEALs, I think that sort of created a little bit of halo. So it wasn't finding people interested, it's finding the right people. And for us, what we were looking for back then, and still today at Sixth Street, is first of all, we want really nice people. We want people that, we have a saying at Sixth Street, and it was true back then. Something we learned from the San Antonio Spurs is like, we want people that are over themselves. Because if you think about a multi-strategy investing business, the enemy of a multi-strategy investing business is fiefdoms and silos. And if you have people who don't want to be team players and share information and share relationships, the whole sort of unitization of risk units and return units, it all breaks down. So culture sort of goes hand in hand with our investing style. So the first thing is like, did they fit in culturally? And then the second thing, obviously, everyone's got to be smart enough, but we really wanted people that could think critically, but also were open to that sort of, the anti of my baby's the prettiest people. They don't fall in love with whatever they're spending time on. They have the ability to sort of, what we would say at Sixth Street is to play tennis, and like comparing a healthcare senior secured loan to buying a healthcare company to a European real estate deal to a Asian infrastructure deal, be able to sort of engage in what we call playing tennis to sort of compare relative risk reward and sort of the backdrop of whatever we think sort of the macro environment is as well.
I had never heard that phrase, people that are over themselves. I love that phrase. Anything else you learned from the Spurs?
So I started running business when I think I was 25 years at Goldman. We always said like, no politics, no BS, no egos, nice people. Like that's what we wanted to be around. And when we started to get to know, so I grew up in Austin, Texas, and I was always a San Antonio Spurs fan. So I was always from afar a big fan of, Popovich and R.C. Buford, who's literally one of the best sports executives. Yeah. He's unbelievable and almost like a brother to me now. He's an exceptional human being. But, we went in there, I was describing Sixth Street, and R.C. based on one of our first discussions says, yeah, we have a saying for that. And so Popovich said the same thing. It's like, are you over yourself yet? Why do you say that? He goes, that is literally the ultimate expression is, can someone be a good teammate? And I thought about it deeply. So we took no politics, no BS, only nice people. And we sort of translated that to now we say, are you over yourself yet?
If you think back to the SSG days, what was the investment or trade that you were most proud of that most encapsulates so many of these ideas?
We obviously did really well. There were a bunch of investments. So I think the thing that we're most proud of is that during 2006 and 2007, when things were getting sort of irrationally exuberant, we actually started to pause. We didn't know what was going to happen in the GFC, but it's almost like what we didn't do. And we were, we're, I think, the only principal investing group, maybe there's one other, that didn't lose money in 2008 on a lot of capital. Now, we didn't make any returns, but we protected capital. And it was all from just sort of that process that we went through of really comparing relative risk units to return.
Yeah, I did one thing with SSG once. And it worked out really well. I bought shares of a supermarket company, and I tried to push for its acquisition, and it did end up getting acquired. I see the market falling a little bit. SPY's down 20 bips. Quantum down as well. So we're up, so good alpha today, almost flat in the book. I've also talked about the risk units, reward units last night, in fact, in our in our Discord. So kind of funny. It's a little bit of a meme.
That would be an amazing thing if that happened.
Can't let that happen.
Speaking of personal information and those kinds of things, I might just pull a thread on that. And you may not know much about this, but this is something that the banking industry is really, really mitigate that kind of activity, or that we should safeguard if there is the use of AI or identification of that type of impersonation.
Great question. I am very nervous about this. A thing that terrifies me is apparently there are still some financial institutions that will accept a voice print as authentication for you to like move a lot of money or do something else. You say a challenge phrase and they just do it. That is a crazy thing to still be doing. Like AI has fully defeated that. AI has fully defeated most of the ways that people authenticate currently, other than like passwords, but all of these like fancy that we have a significant impending fraud crisis because of this. We have tried, I think other people in our industry have tried to sort of warn people like, hey, just because we're not releasing the technology doesn't mean it doesn't exist. Some bad actor is going to release it. This is not a super difficult thing to do. This is coming very, very soon. And there's obviously some reports now of these sort of like ransom attacks where people have the voice of your kid or your parent and they make this urgent call. That is going to get so compelling. Society has to deal with this problem more generally, but people are going to have to change the way they interact. They're going to have to change the way they verify, like this person calling me. Right now it's a voice call, soon it's going to be a video FaceTime. It'll be indistinguishable from reality. And teaching people how to authenticate in a world like that, how to think about the fraud impacts, this is a huge deal.
That might be something we could think about partnering on, the identification of those hallucinations or the intentional impersonations. I think would be a really beneficial thing to engage in. But being the parent of two teenagers, one just graduated from high school and the other's a sophomore in high school. Apparently, a lot of these kids these days are using ChatGPT and other AI to facilitate their work and to complete high school. Do you have thoughts about that and how AI can be used in a beneficial way instead of in this way for kids and with teaching?
Let me tell two stories, and then I will answer that. I never met my grandfather. He died before I was born. But a story that was told to me by my grandmother was about what happened. He was very good at math. What happened when the calculator came out? And he thought, he always kind of liked new technology. When the calculator came out, math teachers at the time apparently said, "This is a disaster. This is the end of math education. If you don't have to learn how to use a slide rule or look up, stuff in the logarithms books or whatever they did at the time, why bother to teach anyone math? Like these kids are never going to learn." And it was apparently a real meltdown. And of course, what happened is with better tools, we use our brain power for something else. We start teaching calculus in high school. We start exposing people to more advanced math. My own version of the story was when I was in junior high and Google came out, and the teachers at the high school, I heard this from the older kids, were really panicked. Because if there was this crazy new thing called Google, you didn't have to memorize facts. You didn't have to memorize the year that a certain war was fought. You could just look it up and what was the point of history class? And if you didn't have to fire up your car and drive to the library and learn to use the card catalog and then walk down and try to find this book, but someone had checked it out and then try to find some other book. You didn't have to suffer that hour. Then what was the point of learning? And I had gone to the library and used the card catalog as a little kid a little bit. And I was like, no, that's a really bad experience. I could do something better with that hour of my life. And again, what happened, so there was this brief effort at my school to ban Google and get these pledges not to use it and whatever. And then people realized oh man, we can give our students more tools and we can expect more out of them. And sure, maybe they drive to the library a little bit less, but they can use that time to think harder or come up with new ideas or do whatever. And that was really great. We expect more, we get more. The potential is higher, but the expectations are much, much higher. And I think it's the same thing now with ChatGPT. It is totally true. Back to that November 30th date when ChatGPT first came out, kind of the first mega passionate early adopters were for sure students using it to cheat on their finals or papers or whatever that December. And you had these school districts falling all over themselves to see who could ban ChatGPT the fastest. So we launched November 30th. By December 7th, some people have banned it. By December 14th, it's really careening off the cliff. Schools leave for the break, and it looks like ChatGPT is never going to be allowed inside of any educational institution again. It's a 2-week-old product. It's done. By the middle of January, you start seeing these things from principals, from superintendents, from serious high-up people in the world of education saying, actually, we made a huge mistake. This is the best learning tool ever. Our students, at least our sort of self-starting students, are using this to go learn anything. If we ban this from our schools, we're just not going to be globally competitive. And we've got to retool our curriculum because this is like the calculator. And now we have a calculator for words. So sure, maybe a take-home essay is no longer the right way to evaluate a student, but that process of learning to write an essay, that process of thinking better because you're I still write things that I never show anybody else just to organize my thoughts. That's really important. So we said, great. Now, the good news is students for sure have learned how to use this to learn better, to teach themselves to think things, to think in new ways. We're going to roll out a new way to help students learn better with ChatGPT very soon. The bad news is, on the whole, in those 2.5 years since, the curriculums have not moved as much as we might have hoped. People seem to have a lot of energy that they were going to have to start educating and evaluating in new ways. And then kind of the molasses of the education system did its thing. And we're still giving a lot of take-home essays. And I think that's a losing battle. We should be teaching people to use, give them assignments that require them to use tools like ChatGPT. Cannot be done without it, that's fine, but expect much more out of them. And I still hope we're gonna get there.
Sounds like a transformation of our education system.
But it has to be. These kids are gonna grow up and be adults with unbelievably powerful AI. And if we're not training them for that world, we've really missed the mark.
That's very helpful. Thank you. I'll make sure my daughter understands what our expectations are as she's finishing high school. But to move back to some things that you've talked about in the past and to move a little bit back to the business community, you've said that AI will make small businesses or it's going to create an environment for entrepreneurs that's going to be second to none. A new era, I think, is what you called it. How do you see small businesses? That's something that a number of our board members are really engaged in, and really we care about making sure that there's new business formation and that there's opportunity there for new entrants in that. How do you see that being transformed, and not just for the Silicon Valley small businesses or new entrepreneurs there, but more broadly?
So the first thing we saw with ChatGPT, as I mentioned, was students. One of the coolest things we saw pretty quickly after was everybody who worked at OpenAI started to get these stories of how people were using ChatGPT when it was still very novel in their business life. And everybody has their favorite, but I'll tell you my favorite. I was in an Uber, and the Uber driver was telling me about this amazing new thing called ChatGPT and asking if I'd heard of it. And I was like, oh yeah, what are you doing with it? And he was like, it's the craziest thing. I have this small business. It wasn't quite working, but now I have an employee in every area. It does contracts for me. It answers my customer support emails. It helps me come up with my marketing stuff. It designs my He goes down this list. And he basically had this business running on ChatGPT. This was before it was a common thing. This is before GPT. This was an extremely early adopter. But he had figured out how to run a business on ChatGPT. And it was not like he was taking jobs from other people. His business just would have failed. He couldn't pay for the lawyers. He couldn't pay for the customer support people. He didn't know how to get someone to design the advertisements for him. He didn't know how to have a system that could automatically bid for ads on the internet for him. And ChatGPT just did all of this. Now, obviously, it's much better now. Now we have a whole industry around us that builds tools with our API to make people really, truly one-click automate all those things I just talked about. But the creative spirit of people that were just doing this inside of ChatGPT, way back in the Stone Age, really stuck with me. And now it feels like it's on easy mode, and people are doing that in all sorts of amazing ways.
It's really transformational, I think, for me. The first time I used it, I was trying to write a haiku for a Kampai toast at an innovation conference, which actually didn't go very well. But but at the urging of my family, of my teenagers and my husband, who's involved in AI too, we tried to make it work, and then went back to the drawing board.
The new version should be much better at haikus.
Great.
It's very good at creative writing.
Think about that. But I wanted to make sure we have some time for audience questions, if you're up for that. I see Anil in the front row. If Anil Kashyap with the Chicago booth.
Hi. So I assume one of the things that financial institutions will begin doing is using this to mine their data, maybe to do credit scoring, credit evaluation. What do you say to the people that are worried that it's going to be picking up patterns and making decisions on things we wouldn't want to? And how are you guys thinking about protecting against that?
So this is deeply outside my area of expertise, so I'll answer in the general case. One of the things that is cool about these models is they understand us in natural language, and they're so steerable. So if you say, hey, you can go look at all this data to make a decision, but don't consider X, Y, or Z at all, don't let that have any factor, it generally speaking will really be good at following that. The doing this in language models is different from the way that we used to do this sort of like just group all this data together into these clusters, and so you can really instruct, and it will really follow your intent. The second thing is, I think the question behind the question there is that these models are going to be very biased in ways we don't like. I think humans are quite biased. I think AIs are dispassionate and unemotional and don't have the kind of like built up, whatever that people do. And I think it'll be possible for AI correctly built to be a significant debiasing force in many industries. And I think that's not what many people thought, including myself, with the way we used to do AI, but on the current trajectory, that seems very possible.
Hi, Sam. Stephen Scott with a company called Starling. I recently had the opportunity to interview Craig Mundy, who wrote a book with Henry Kissinger and Eric Schmidt, where they describe AI as almost the evolution of a new species. And Craig was saying that we can teach AI human moral codes, they can learn it and reflect it. So there's a lot of talk about the ethics of AI. My question for you is, will AI evolve its own morality?
I think people get very confused about whether they want AI to be a tool or a creature. And I'm very much in the tool camp. I don't think AI will have independent morality. I think that AI can certainly learn, really study humanity and the best of our thinking. It can probably help us point out, here's a problem in your thinking, here's a thing that should be different, here is like a real moral gap. And I don't know what the giant moral gaps are in our current worldview, but I guarantee you there are some. And if it can help us find those a little bit faster, I think that would be, if it could point out those inconsistencies, I think that would be helpful. But I think it is easy to sort of impute creature-ness on AI that is not there.
Thanks. I read recently, it's weird to use the phrase traditional internet, but there are some people who say that AI will sort of destroy or really reshape the traditional internet, whether it's search, whether it's lots of other things. And obviously there's a huge economy now that we built on that. What's your sense of the amount of change that's going to happen in that world, where AI will be most disruptive and where things will be more status quo?
I do think there are all of these things. So I think AI will be somewhat disruptive to the way people currently use technology. The reason I was smiling is there's this funny thing that happens. Older people, or people who are used to like emailing with a certain kind of etiquette, will type out the bullet points that they want to communicate, put it into ChatGPT. ChatGPT will write this long, nice, formal email with a bunch of like fluff and the bullet points somewhere in there. They'll send it across to somebody else. That person will put it back into ChatGPT and say, please summarize this for me. And on the whole, the high school students think this is ridiculous and just say, just send the bullet points. Like that kind of like formal email thing is dead. Just like, you're generating on one side, you're collapsing it back. This is ridiculous. And it's funny, but I think there's something about the way we use the whole internet that is encapsulated there. Like when I wake up in the morning, I go through a bunch of apps. I read messages across 5 or 6 different things. I go check, a thing here, a thing there, a thing there. And what I really would like, and then my phone all day long is just like blowing up at me, and it feels like I'm like walking down the Las Vegas Strip and these things flashing at me, and it's very distracting. People like shoving things in my face. And what I would like is my AI agent to be off using the internet for me, knowing when to interrupt me. It can tell when I'm, focused working. It can tell when I'm in a meeting. It can tell when I'm like got some time to think. It can override if necessary. Otherwise, it can like nicely summarize stuff, respond to things for me, pull the things together. And, I want like that bullet point condensed thing. And I don't want the fluff. And I don't have to like go around and click around, and I don't have to, respond to stuff I don't respond to. But that change is probably fairly disruptive to the way that the internet works now. And I think there'll have to be new business models that go along with that. Like you'll have to have new ways of paying for content. I have always wanted micropayments for content on the internet. I hope that finally happens. Maybe there'll be like new ways that we actually reduce, spam and message overload with new kinds of protocols. But it does seem like we're heading towards a very different way you will start your morning with technology when you wake up.
I'm Peter Hooper, Deutsche Bank. Sam, thank you very much for prolonging a career here, at least raising productivity as the years advance rather than seeing a drop off. You mentioned you're expecting significant job losses and significant job gains. Could you talk a little bit more about the areas and the potential disruption that could cause?
One thing I believe, just as a general statement first, is that we have no idea really kind of like how much more labor supply it would really take to meet true demand today. When you are sitting in a doctor's office waiting room for an hour, I think that just means undersupply of doctors. Or that the doctors aren't productive enough. And, it would be great if the doctor's waiting around and as soon as you get there, like, they're ready to see you and they have the whole thing ready to go. Lots of other examples like this. Every time you're, wasting your time in any way, every time you're kind of clicking around the internet, can't quite do the productive thing. I think we are in an undersupply of labor to a degree that is going to look horrible in retrospect. Now, some areas, again, I think just like totally gone. I don't know if any of you have used one of these like AI customer support bots, but it's incredible. A couple years ago, you like call customer support, you like go through a phone tree, you talk to 4 different people, they do the thing wrong, you call back again, you wait through it. It's like hours of pain, ton of time on hold, and the thing that you want doesn't happen. Very frustrating experience. Now you call one of these things and AI answers. It's like a super smart, capable person. There's no phone tree, there's no transfers. It can do everything that any customer support agent at that company could do. It does not make mistakes. It's very quick. You call once, the thing just happens, it's done, answers right away. Great. Now, I don't want to go back there. And I also it doesn't bother me at all that that's an AI and not a real person. So that's a category where I would just say, you know what? When you call customer support, you're going to be talking to an AI. And that's fine. A lot of these other things, I really do want a human doctor. ChatGPT today, by the way, most of the time can give you it's like a better diagnostician than most doctors in the world. And I'll like many people here, probably put my symptoms in and test results. And, there's all these stories on the internet of ChatGPT saved my life. And, I had this rare disease and it found it. And all these doctors didn't do it. And yet people still go to doctors. And I am not maybe I'm a dinosaur here, but I really do not want to entrust my medical fate to ChatGPT with no human doctor in the loop. Would anybody here rather just have ChatGPT diagnose them than a doctor? Even though you know it's better? That's quite interesting, right? So this is a class where we're going to keep doing things largely the way that we did. We talked earlier about this example of computer programmers. Again, I think it's amazing that a computer programmer is now 10 times more productive. Salaries of programmers going up extremely rapidly in Silicon Valley, so are expectations. And it turns out, I think the world wants a gigantic amount more software, 100 times, maybe 1,000 times more software. So maybe each person can now write 10 times as much software. They're going to make 3 times as much. The world will be happy because the world has wanted way more software. The programmers will be happy too. And I think we'll see many categories like that. Things in the physical world will keep being done by humans for a while, but when this robotics wave comes crashing in another 3 to 7 years, I think that's going to be a really big thing for society to reckon with. Yeah, that's kind of what I summarize it.
I think we have 2 more questions over here, and we might have time for a third, but let's go ahead. Rob, you already have the microphone. Would you introduce yourself, please?
Sure. Rob Blackwell with Interfi. We've been raised on decades of sci-fi telling us that AI is eventually going to kill us all. And since you know more about AI than arguably anybody in this room, I just want to ask you, what does keep you up at night? What are the things that you worry about when it comes to AI, and how do we prevent those things that you worry about from coming true?
I think there's three sort of scary categories. There's a bad guy gets super intelligence first and misuses it before the rest of the world has a powerful enough version to defend. So an adversary of the US says, I'm gonna use this super intelligence to design a bioweapon, to take down the United States power grid, to break into the financial system and take everyone's money. Something that would just be hard to imagine without significantly superhuman intelligence, but with it becomes very possible. And because we don't have that, we can't defend against it. So that's broad category one. And I think that the bio capability of these models, the cybersecurity capability of these models, these are getting quite significant. We continue to flash the warning lights on this. I think the world is not taking us seriously. I don't know what else we can do there, but it's this is a very big thing coming. Category two is the sort of broadly called loss of control incidents, where that's kind of like the sci-fi movie. The AI is like, oh, I don't actually want you to turn me off. I'm afraid I can't do that, whatever. And I think that is less of a concern to me than the first category, but a very grave concern if it came to pass. There's a lot of work we and other companies do on model alignment to prevent that from happening. But as these systems become so powerful, that's a real concern. And then there's the third one, which I think those first two are sort of easy to think about and imagine. The third one is, to me, more difficult to imagine, but quite scary. And I'll explain what it is, and then I'll give a short-term and a long-term example. This is the category where the models kind of accidentally take over the world. They never wake up, they never do the sci-fi thing, they never open the pod bay doors, but they just become so ingrained in society, and they're so much smarter than we are, and we can't really understand what they're doing, but we do kind of have to rely on them. And even without a drop of malevolence from anyone, society can just veer in a sort of strange direction. When I was a kid and Deep Blue, that AI system built by IBM, beat Garry Kasparov in chess, I remember my dad saying, this is the end of chess, and no one's going to play it again. But then it turned out that actually, although the AI was better than humans, AI plus a human together was way better than an AI or the human. The AI would present 10 options, and the human would pick the best one or something like that and play the move. And everybody said, oh, we have this wonderful future of man and machine together. It's all no problem, whatever. That lasted 2 months, 3 months, something like that. And then the AI got so smart that the human only made it worse because they didn't understand what was really going on. And the AI alone trounced the AI and human. It's been like that ever since. Now, another interesting part of that story is everybody was convinced in the 90s that was the end of chess, because if AI could beat humans, why should humans care? Chess has never been more popular than it is today. People love to watch chess. We're very focused on real people doing real people things. So there was a very interesting thing that happened there. But this phenomenon, I think, is a really big deal. In the short term, you can see it where people we call this emotional over-reliance. People rely on ChatGPT too much. There's young people who just say I can't make any decision in my life without telling ChatGPT everything that's going on. It knows me, it knows my friends, I'm gonna do whatever it says. That feels really bad to me. And is a really common thing with young people. And we're studying that, we're trying to understand what to do about it. Even if ChatGPT gives great advice, even if ChatGPT gives way better advice than any human therapist, something about kind of collectively deciding we're gonna live our lives the way that the AI tells us feels bad and dangerous than a bunch of things like that. The longer term category is, back to that chess example, what if AI gets so smart that the president of the United States cannot do better than following ChatGPT 7's recommendation, but can't really understand it either? What if I cannot make any better decision about how to run OpenAI, and I just say, you know what, I fully hand it over. ChatGPT 7, you are in charge, good luck. That might be the right decision in any individual case, but it means that society has like collectively transitioned a significant part of decision making to this very powerful system that is learning from us, improving for us, evolving with us, but in ways we don't totally understand. So that's the third category of how I think things can go wrong.
I think there was one question behind you, Rob. And then I might just ask you to wrap up by helping us encourage innovation in the banking system and how you might recommend we do that.
Hi, Joe Cavatoni with the World Gold Council. I think you're kind of touching on it in your third example that you've just given. Can you give us a little bit of thinking on what you're thinking about developed markets and the benefits that come to developed markets with AI, also developing markets? Because this is potentially a level-setting phenomenon that could develop, correct?
Very much. I think it'll be a deeply level-setting phenomena. Like, you know, maybe you don't love the healthcare or the banking system in the United States, but at least you have one. You know, at least you can get financial advice. At least you can get medical advice. In a lot of the developing world, the alternative to ChatGPT doctor is not a real doctor. It's nothing at all. And then you definitely rather have this. And if this keeps getting better fast enough, maybe you just get better service in the developing world in a bunch of ways. But I am very interested in what it means to give everybody on Earth like a free copy of GPT-5 running for them all the time. Every business really enabled with this level of technology to be able to give better financial advice, to detect fraud better, to underwrite risk better. Again, watching what is possible now makes me very optimistic. In the developed world, I think the biggest challenge will be risk tolerance and regulation for very good reasons, but about how quickly do you want to adopt these things. And I think like we've seen with a few other technologies, in much of the developing world, people will just skip a few generations. It'll feel like, you know, mobile and the internet sort of, and they'll go right to just, you know, we're going to run everything on AI, and we're going to deliver goods and services, at least services, at 1/100th of the cost. And I think you'll see some economies transform there very quickly. I do think that in, you know, obviously I'm most familiar by far with how things work in the United States, but I do think financial services here should just be completely different in another decade. Like the way that we move money, the way that we give financial advice, the way that we think about underwriting risk. It just seems like we can so dramatically improve all of that so quickly now.
How do you see OpenAI or your services facilitating that evolution? And how can we as regulators think about what the constructs should be as we're implementing or allowing for innovation to occur?
Promise I didn't come here for the TV commercial, but we'd love to work with any of you, of course. No, whether it is us or one of our competitors, I think that just in the last 6 months, as reasoning models have really rolled out, this transition from these models that could think not at all and had to give an instant response to models that can think for many seconds or many minutes. And the robustness and reliability that's come with that means that for an industry like this, I think the technology is finally really usable. And a lot of people have not tried the latest generation of models. But I think if you do, you'll be like, oh, this is, you know, like much smarter than most people. And then on the government side, I think it's the same thing. Like government has got to embrace this technology, and we'll be able to do everything better.
Well, thank you, Sam, so much for joining us. We ran a little bit over time, and I'm sure everybody's ready for lunch.
Thank you very much.
We
Sorry
really
for keeping you.
Units, and we started to see things that just didn't make sense. We still invested, but we're investing in different things that we thought would be very protective because we didn't know when the party was going to end, but it just was getting out of whack. And that I'd say it's really what we didn't do leading up to GSC is probably what I'm most proud of. And quite frankly, I think had that not happened, I don't think we could have, when we started Sixth Street, raised the first fund we did, had we not protected capital in 2008, because so many people in seats like mine, blew themselves up during the GFC.
Back then, did you think of yourselves as like financiers, like doing a primary job for the person or group receiving the capital, or did it feel more like arbitrageurs or something like that?
We love investing. And it was really about just being trying to create solutions. Because our capital is so flexible, we could go sit down with any CEO or any management team. One of our core skill sets is asking questions. So we'd just be asking questions. And what we say that the prototype deal at Sixth Street, but also back then, is we can get on a whiteboard with a CEO management company. They have kind of an idea what they're trying to solve. And we get up there and we start whiteboarding it and we come up with solutions. We'll come up, maybe it's a structured equity investment. Maybe we buy an asset. Maybe we do a joint venture on one of their assets. It could be anything, but we walk in there with a very kind of entrepreneurial mindset, bespoke mindset on every deal. And that is if you talk to any of our investors, what is a Sixth Street deal? That is a Sixth Street deal. It's just whiteboarding with the CEO or management team, and we can do that at scale. So back then, that was really how we were thinking about things. And arbitrage, when I think about arbitrage, that's short term. We're long-term investors. We're 3 years to 10-year investors plus. So arbitrage to me, that's more trading. We weren't traders. We're terrible traders. That's not what we do. But thinking about fundamental value, but also trying to find the right management teams, the CEOs to back, and then getting to those dynamics where we're really their partner and we're able to get on a whiteboard. That's kind of was a prototype deal for us.
It's like a fundamentally creative process. It reminds me of Richard Rainwater and all you heard about how he would structure things and kind of take all comers, lots of whiteboards in that office, apparently.
We just had our offsite. I talk about right brain thinking. And we always say and one of our core principles is don't groupthink, stay away from water. That's why I benefit being out in San Francisco. I live with all the AI tech guys that are all on your podcast, and I learned from them. I'm like a fish out of water there, but it's just that independent thinking. That's why people who know me well, I've never talked to competitors ever. Not because they're not super talented and great investors, because I don't want to be sort of infiltrated with their thinking, so I get into groupthink. And that's why we try to really think about things through that right brain lens, because that's how we start different businesses. That's how we find new themes. And we can't do our business if we're not using our right brain. It's a core part of what we try to do.
One of the really cool things about your structure is this unit of risk concept. Mm-hmm. Hearing you talk makes me realize that basically every investor takes their specific unit of risk for granted. It's the same every time. And I find that fascinating.
When we came out of Goldman, I'd never talked to an LP before. I didn't know how to talk to an LP. That's a whole other story. One of my mentors in and we call him the godfather of 6th Street, Jamie Gates. Like our first fundraising meeting we went to, he's like, kick me under the tables with a large sovereign wealth fund. Kick me on the table. I'm like reading every word on every page. He's like literally like doing these hand signals, like, let's go, kicking me. And it was not good. We never talked to an investor, but I remember getting out when we first started talking to investors on 6th Street. We had a really hard time in the beginning because if you think about the LP world, the way it's set up, it's very siloed. You have your private equity group, you have your fixed income group, now you have your private credit group, you have your real estate, your infrastructure. So the only reason, like, we got lucky because David Vineyard was our CFO. We had one LP, so we were completely unconstrained and unsiloed. We just couldn't lose money. You know, you grow up in the world today, like when I first got out and we're talking LPs, I'm from, let's say, a very big pension plan. And at first, and I'm describing what we do, and they can't fit us in a bucket. They're like, wait a second, are you in this bucket? Are you in that bucket? He said, we need 20% returns. I was like, okay, well, how much leverage are you taking to get 20%? It didn't matter. No one thinks about unit risk. They only think about nominal returns. And that's why we've always talked about from the beginning. And I think many LPs have gotten a lot smarter on return units and risk units, but nominal returns, they're just underlying risk because there's so much leverage out there. People can make returns whatever they want through leverage. So, but it's not capturing units of risk. And at some point, I think the AI is going to figure out how to quantify units of risk for private capital. That'll happen someday. That has not happened. People still think about just nominal returns versus just the skill of investing.
Yeah, so where I was going with it was typically it's on a line of question, like walk us through your thinking about risk. Like maybe they'll think about loss ratios, basics, some basic stuff, but not multi-dimensional thinking around risk in a given asset class. And so I'm curious, because that's all you've ever really done as an investor, for you to teach us some of the surprising things about what you've learned assessing risk versus everyone spends so much time assessing return. What could this be? What could the return be? Less time on the risk side. What would surprise people most is the most important parts of that evaluation process?
Human beings get into behavioral patterns and they look at the past and they just sort of keep going. Like I'll give an asset class like direct lending. Direct lending has oscillated between a really great time to invest and a less good time to invest, and it's all driven by sort of capital flows. You know, somewhat recently, you see a whole bunch of new money coming into, let's say, direct lending, and I think people get caught in these tunnels and have a hard time sort of stepping back. Either they don't have the sort of the periphery to look at it, or they don't have people around them that have been through cycles, but they get in these sort of behavioral patterns and they have an inability to sort of look back. And I think whenever there's a crisis and people lose money, and we saw this in 01, 02, I saw it a little bit in August 98, definitely saw it on GFC, saw it in COVID before the Fed bailed everyone out and made everyone, some people that shouldn't have looked smart, but that's a whole other, that's a whole other thing. I think people are surprised when that happens, but it's all right in front of you. It's like in 06, 07, you could have looked at what was happening. Like there was like over 100% loan to value loans to houses. Like anyone could get a mortgage. There were all these mortgage lenders just pumping with no sort of, consideration for credit quality. And I think just the tunnel vision of ignoring sort of not only the risk units on that particular deal, but the risk units of what's around you. And I think that's one of the biggest mistakes that people make. And I don't know if people are surprised by that, but it's very hard to evaluate risk units if you're only looking at it through sort of one lens versus multiple lenses. That's what we learned back in 2001, 2002. We had all those 10 disparate businesses where no one was talking to each other. And that's why they were actually put together. I give David Vineyard a ton of credit as probably the best CFO, in my opinion, ever on Wall Street. He is one of my mentors. He is exceptional, but we're the biggest investor out there back in the late 90s and early 2000s. And, there was a bunch of loss-making businesses from all these disparate principal investing businesses. And that's why Goldman put them under one umbrella. I think that pattern of not just thinking about things in a siloed way versus being able to look sort of the overall periphery, I think that's what we're going to be talking about sometime here in the next 2 to 3 years.
To continue to contextualize this notion of units of risk today, what do you think are some of the maybe overlooked sources of risk in the system as you see it, since you get to see it from every angle? And this is early summer 25.
We have experts at Sixth Street, like my partners, Marty Chavez, who's on the board of Google, and Adam Korn, who ran Goldman Sachs Engineering Business, who are experts on AI. So I'm not an expert on AI, but I think one of the things that you've talked about on your podcast is just the whole transition from sort of once the productivity gains start to come, there's obviously going to be job losses, and just the transition to sort of remobilize capital, and just how's that going to work? How's that going to work with the real economy? I don't think enough people are talking about it. One of my good friends, Jeff Weiner, former CEO of LinkedIn, he's the chairman. Him and I have been talking about this for a while, and I think for the first time, Anthropic CEO actually came out and said something publicly. So what I'm worried about there is that we're so focused on competing with the U.S. stated against other countries, specifically China, companies, all the big hypers, the MAGA 7, they're all focused on competing with each other. And I don't think there's enough people talking about how we're going to manage this transition as, again, there's going to be lots of productivity gains, which I'm all for, but there's not enough talk about that. Like, to me, it's like, it should be code red people talking about it, and that's not happened. So I'd say that's one. I think the other thing, and I think it's an opportunity. Look, you look at the average wealth investor, so the Wealth Channel, which I'm sure people have talked about on your podcast. They're relative to just a traditional in their private portfolios. They're underexposed to private alternatives relative to, say, a pension fund at, call it 40%, or an endowment at 50%. So at 3 to 5%, that should probably go up. But again, the transition, there's now, everyone's all about the Wealth Channel. Everyone's talking about that. The transition to do that in a way that's responsible to those wealth investors, those end market. And I think, getting to the right structures so that, that's done in a responsible way. I think that is something to watch out for. Jamie Gates, godfather of Sixth Street, one of the things he taught me early on is, like, just because you can raise capital doesn't mean you should. And I think that's, just because you can raise, I think as a GP, as a manager, just because you can raise it in the Wealth Channel doesn't mean you should. And I would espouse that advice to all of our people in our industry.
So I want to keep telling your story. So after Goldman, but before TPG, what were you doing then?
I actually told David Vinier, who was a mensch in March 2008, that, I wanted to basically rebuild what we did at Goldman, but do it in a more entrepreneurial backdrop. I stayed through 2008 just to make sure everything was well, because I wouldn't have felt good if the rails would have come off. Like, there's no way I was going to leave those guys at that time. And then, I took 6 months off, got married, went on a honeymoon. But before that, really started building our basically constructing the idea of Sixth Street, which was formulated in a business plan called Project Austin. And Project Austin laid out our values, our culture, our investment philosophy, all laid out our 5-year strategic plan, which is a big thing at Sixth Street. We're now in our 4th 5-year strategic plan. We've been doing that since day one of the firm. And that sort of set out the idea of Sixth Street. TPG, we're set up a little bit differently. So we were never like employees at TPG. We never gave up control of our business. We always controlled investments, hiring decisions. We were kind of a firm within a firm. TPG had a minority equity stake, and we're great partners for, while we were together. But that's sort of how it all started.
Say more about these consecutive 5-year plans. How do you do that?
Our view on business building is if you don't have a compass, it's hard to know where you're going. And more importantly, it's hard to get everyone on your team matched up with that 5-year strategic plan. We just finished our 5-year strategic plan. It's an 18-month process, 200 pages. I mean, this is like the hundreds and hundreds of hours of all the partners debating, trying to really narrow down, what it is, the direction of the firm. Back we first started our 2015 plan, what we wanted it to be, and most recently our 2030 plan. And we narrow it down. We typically have like 80 ideas. We narrow it down to sort of 40, really what we call subplanks, and those are organized under sort of 5 strategic planks. We'd actually just present it to our entire firm. But what we try to do, and this is something learned at Goldman, is we basically take that 5-year strategic plan, we break it up into 1-year increments, and then we have every person at the firm do their own personal business plans. And what we always say, and this is from day one, is that we want the summation of all those personal business plans to equal the 5-year strategic plan. So we're matching every single person in the firm with the clear mission of what we're trying to do, and what we'd say in our parlance, climbing up the mountain together. And that's just been a process, and it's something that we take very seriously, evidenced by we spent 18 months and hours of, debating it and, thinking about what we want to be and how we want to go about it. But it's something we've been doing, and it's our North Star, it's our compass, it's everything. And, it's an important part of the process in the business building of 6th Street.
Can you talk us through the opening chapter, like chapter 0 or the prologue in chapter 1 back in 2009 or so, sure. and what was going on? What were what the biggest challenges were? I'm always interested in how these firms get started, and what challenges they have to overcome, because often those are like the formative periods that then last a long time.
Yeah. We're a values-driven firm. So our values are, number one, what we call our one life principle. You have one life. Do you want to be average or great? Everyone wants to be great. So that's the first thing. But what that's really for is like, we want people that are all in. Like, it's a competitive world out there. Like, we want people that are all in. The second thing, and this goes back to, one of the things we're talking about, is we want curious people that are constantly learning, that actually are constantly trying to grow. If you think about the idea of having to develop new themes every year and new ideas, like, we need entrepreneurial people. And then the third thing is a one-team culture. So people that are over themselves, no politics, no egos, no BS, just so we can all talk to each other. So those are the values. We always said we wanted to be the largest startup in the industry. Like, that's literally day one. We want people that can play tennis, so they can debate, not the my baby's the prettiest type people. And then the last one, we want people, and this is on culture, something my dad taught me about, facing the tiger. My dad's a crazy person. He's like a black belt, yells at the TV. He's probably listening to this, but he's a pretty tough guy. But he always taught me growing up, like, you got to learn how to face the tiger. And this whole idea of like, and by the way, when you go to 6th Street's offices, literally you get off the elevator, there's like a big tiger just staring at you. And there's 3 elevators, and no matter what elevator you get off, it's like staring at, it's staring at.
Is it a sculpture?
It's huge. It's like 5 feet. You'll come to our offices one day. It's easy to have a culture when things are going well, but the cultures are defined when things go wrong. So it's like when something goes wrong or there's a challenge, you go through different things. Like, most people are like pointing their fingers at other people, or it's not my fault, or they're running away. At 6th Street, we're like, good, let's go. And we say, let's face the tiger together. Look, the first thing is like defining values and culture in our investment philosophy, which we spoke about. But then for us, like, what's our genetic code? We want to be an investor first firm. We love investing. We love this idea, this process we go through. We love meeting CEOs and management teams. And particularly today, where it was starting to happen back then, like, there's a little bit of asset aggregation. Now it's a completely different thing. Our ethos and what we want to be, like, we're investors. Like, if you talk to our partners, the day we become not an investor first firm, we're not here. That's literally number one, is like every review process, every person we hire, it's sort of designed around, we want people that love to be investors. So that multi-strategy, so this idea of like the world's dynamic, it's always changing, laying that part out in terms of being a multi-strategy investing firm, migrating the best relative risk units and return units, thinking about that. And then the last thing is,
there is a Shkreli YouTube watcher who grew up on my videos and now has a senior job at this exact company, making lots of money. So, I'm so happy when I hear stories like that.
It's just, overall, just that whole cross-platform collaboration at scale, because our business model doesn't work if we don't have that cross-platform collaboration at scale, because otherwise information and relationship get trapped in fiefdoms and silos. Like, Sixth Street, we have 10 investment platforms, all organically built. You know, all the people, the business leaders at each of our investment platforms, they all talk to each other all the time. You know, we're all trying to think about where's the best place to think about, again, comparing sort of risk units and return units, and obviously places where we can be value-added partners to CEOs and management teams.
What are the dimensions of facing the tiger well? Like if you were teaching a college seminar on how to do this, what would you tell the students?
Human beings' natural reaction when there's a problem, and you can see this in so many facets of life, the first thing is to run. First thing is to run. Particularly in our industry, the second thing is to like point. I saw this happen in other groups at Goldman. I've seen this happen in different companies, and I've have friends that have told me stories is like, you know, all of a sudden there's a problem or there's a bad investment, and all of a sudden everyone starts to try to distance themselves from that, maybe point the finger at someone so it's not them. Or some people get, you know, just they freeze. They start to get hyperactive and they start to make rash decisions. For us, you know, it's good. Let's go. Like, let's go. We're going to do it together. You know, there's one of our worst investments of all time. It was a plastic bottle company. And I'll never forget, it was the only time at Sixth Street, knock on wood, we got defrauded. We made a structured equity investment in a company, I won't say which one, but a European company. And I'll never forget, we were in the room in New York. We were in like one of these rooms with like 30 people. There was a bunch of different investors, a big company. We figured out that they had like defrauded us, and not only us, other investors. And I'll never forget, we went to PJ Clark's in New York. Is that the hamburger place? Yeah. And there were like 5 of us there, and we went over there, all from different groups, because we all sort of, we didn't know there was like a real problem. We knew things were not going as well. And we basically went to PJ Clark's and we're like, holy shit, what is going on here? And we're like, okay, let's go. Stephen Plush, you're going to do this. Sam Ditter, you're going to do this. I'll do this. Borna, you're going to do this. And we just started doing, we called in some other people. And we literally had a team of like 12 people, all different parts of the firm, like just doing everything we could. And the reality is, you know, we ended up getting 50 cents on the dollar. We should have gotten 2 cents. And it was all because like, it was just like game on. And that's what we do. Now, when things are going well, obviously you don't have to do that. But again, what we always say, you know, that's what defines cultures. And you have those moments of, what are you going to do in this situation? Are you going to do the right thing? Are you going to come together? Are you going to point your finger at someone else? Like, what are you going to do? And our whole thing is like, let's face the tiger together, and that's what we do.
I would love to tell the stories of the Spotify and Airbnb investments that you made, because people know those names, so it's, you know, very relatable, but also I think are good examples in the mid-2010s. Sure. Of a little bit later with Airbnb of how you do business. So maybe start with the Spotify one and just like tell that story.
So first of all, we love Spotify as a theme. You know, there's a lot of, we love live music. I grew up in Austin, Texas. It's hard not to like live music when you grow up in Austin, Texas, but you know, great product, great unit economics. But if you remember in 2016, there was starting to be a lot of commentary about threats from Amazon, Apple, and there was a cloud over the company at that time. A lot of people don't remember that. So there's a little bit of volatility in the markets, but more importantly, people were worried about the competitive threats. And look, when this came in as an opportunity, obviously we had a number of themes like, you know, technology businesses or software businesses that we thought had really good unit economics. This was like one of the tops of the list. So that was at a time when they were still going through, they weren't producing cash flow, so they're still, still creating cash flow losses, and you know they need some liquidity. So our investor group stepped in. We gave them $1 billion financing, a convertible instrument. You know, obviously spent time with Daniel. It takes 1 second to figure out that guy is generational. The rest of the team that Daniel had put around him was great. Barry McCarthy. At the time was the CFO, really smart guy. And then everyone we met on the management team, again, going back to what we talked about Sixth Street, mission aligned, they had values, they had a culture. Like it was very clear everyone was on the same page. And by the way, it's sometimes in companies, like you go in and you talk to the CFO and what's the vision? And that's different than the CEO, different than the head of revenue. And for them, it was just very clear that they were just dialed in. They obviously had first mover advantage. And at the time, obviously it ended up being a great investment for us, but it was a little bit contrarian when we made the investment.
Maybe say a little bit more about the security itself. I'm just so curious how because you can operate in any part of the capital structure or whatever, like you said. I'm always curious, like the actual way you did it.
So on that one, what they were trying to solve is at the time, they didn't want to raise common equity because of the competitive threat from Amazon and Apple, or perceived, I should say.
Didn't turn out to be that way.
Didn't turn out to be perceived. Because of the market volatility, they didn't want to sell equity because it was going to be at a lower equity than the last round. So they were looking for more of like a whiteboard solution. And that's literally Barry McCarthy, whiteboard, what are we doing? He had certain principles, and we just tried to solve around those principles. And that came up with, it was a convertible debt instrument. It had a cap. I think the cap was at $25 billion. It had a current yield component. And then obviously the whole idea was to bridge them to get public. So it was like a pre-IPO security to bridge them through that. And ultimately, it was successful and went way through the cap, which created a win solution for them because they got to their IPO, which they were very focused on doing for a whole bunch of reasons. And for us, it worked out, but it was almost like an engineering and whiteboarding. And again, a lot of times the ideas we're giving them, hey, here's the holy grail idea. It's from just talking, playing tennis, asking questions and listening. And that's literally what we do. That's what we train our team to do, is how to ask questions, how to listen. That's literally the process that we went through with the other investors.
Before we get to the Airbnb story, can you talk about Tau and the unique nature of this like massive pool of capital that you've created that can do whatever it wants? Because I'm always fond of this idea that what you end up getting from an investor reflects their capital base. Who it is, the duration, the terms, like they then ship their capital base in the form of investments. And so I think understanding Tau and the overall structure is important.
When we were doing Project Austin, which is our original business plan, we literally studied every GP. Like we had case studies on every single GP, what they did right, what they did wrong. And we also spent a lot of time on figuring out, and I won't name them, some of the GPs that were big brand names and then just kind of faltered away. What we sort of concluded, and this is a pretty obvious thing now, but is that where people get into trouble is they raise larger and larger funds in a strategy that maybe it's the right time to raise a larger fund, but maybe it's not. What's the opportunity set? So they kept raising larger and larger funds, and we didn't want to have that pressure. So the way and this is getting to Tau, we wanted to design our architecture at Sixth Street, which is different than any GP out there, at least the ones that I know, as an investor-first architecture. And what we did is, although we have 10 investment platforms at Sixth Street, each one of the platforms, so think about our growth business. If we didn't have Tau, we'd probably raise an $8 billion fund because we want to be able to do the larger deals. But because we have Tau, we want to keep the fund sizes to the level of the opportunity. But we also want to be able to do the largest deals in the market. I mean, we want to be able to do the $1 billion, $2 billion. We're one of the handful of firms in the world that can consistently write $1 billion plus checks across asset classes. But architecturally, we keep our investment platforms funds at modest sizes, so matched to whatever the opportunity is over whatever the investment horizon of that fund. And then we have this vehicle called Tau on top, which is effectively, in our words, was like the synthetic, when we first raised it, the synthetic Goldman Sachs balance sheet, which could do anything. Obviously with the same principles that we've had for the last 25 years, when we started, 25 plus years, we started investing at Goldman. But that gives us the ability in a growth deal, let's say the next Spotify deal comes, and let's say it's a $2 billion deal. Well, if we only have a $4 billion growth fund or $3 billion growth fund, there's no way we're going to be able to do that in the growth fund. But by having a $30 billion fund sort of over the top, sitting across the entire firm, we have the ability to keep the fund sizes small, but at the same time, speak to the larger deals. And then also anything that doesn't fit within any of our investment platforms, we have the flexibility to do that. Tau is flexible from asset classes, so it's got everything in there: real estate, infrastructure, private credit, growth, mostly private, but has the ability to be public. It can go anywhere on the duration spectrum. So it could do, a 2 to 3 year investment, but we have investments in there like with Real Madrid. We have a strategic partnership with Real Madrid and also a strategic partnership with FC Barcelona. We're probably the only people in the world that actually are partners with Real Madrid and FC Barcelona because they trust us, but we're, those extend further than 10 years. So we have maximum flexibility or unconstrained because, again, that's what we learned at Goldman. The world is dynamic. It's always changing, and you need that flexibility because you never know at that particular time or this particular environment where's the best sort of opportunity is going to be. We always want to have that flexibility to migrate to wherever the best opportunities are. And that's kind of how we think about it. But I think the most important thing about TAL is that it's consistent with who we are as a firm and our ethos about we want to be an investor first firm.
Okay, now let's go back to Airbnb because I think this is like a classic early COVID example of the returns to flexibility.
We're one of the few firms in the world playing offense at the beginning of COVID. And the reason we're playing offense because we had a good defense and we had, again, very similar to what we saw in 06, 07, we started to see those same dynamics going back to we talked about sort of tunnel vision of investing. We started to see some of those same dynamics in 18 and 19. We couldn't have called COVID, but again, things were getting skewed in a wrong way. So we protected the portfolio. We're in a position to play offense. So I'd say that's kind of the first thing. The second thing is right when COVID hit, we went around and said, what are the best business models in the world that are most impacted by COVID? And we did literally, this is think about 60 people across 6th Street, working weekends, all day, every day, trying to figure out what are our themes, our 15 to 25 themes before COVID. Obviously, we threw that out the door. And what are our next 15 to 25 themes? And at the part of this was one of the themes there was best business models most impacted by COVID. So Airbnb, great business model. If you remember at the time, again, another generational CEO and founder, Brian Chesky, there was a lot of negative press on Brian Chesky at the time, which was, by the way, unfair and unwarranted, but there's a whole bunch of stuff, and this is all public, going on at the board. And that didn't deter us. So we literally started calling into the board, people we knew on the board, calling in the bankers, just trying to get any way, because we didn't have a pre-existing relationship with Brian, but we knew people that were around him. And, ultimately came in, and that was an interesting time because the thing that Brian did that was really smart, he did a lot of things that were smart, the way he operated through that. And the first time we met him we were on a Zoom call with 30 squares or 25, I don't know. He must have he had a lot of advisors. And despite all that, his values, the mission, the principles were all the same. We talk about a lot of special humans today, Daniel and Brian, David Vineyard, special humans, but they wanted to fortify their balance sheet so they could play offense. So we and our friends over at Silver Lake basically gave them $1 billion, $1 billion financing. It was in a loan form. It's all public, had some warrants attached to it, and ended up getting them through the period. Obviously, things started to get better, but the most important thing after that happened, they were able to start playing offense versus playing defense. And I think the other thing it did is it really solidified, I think, what we already knew, that Brian was such a great leader and he was able to get this done.
I'm curious, again, in your framework about what the unique units of risk were in that specific transaction relative to those returns.
First of all, we had to be right on the business model. So look, we had from afar, we wanted to make sure that the business model, what it was. The second thing is they wanted to get it done in 7 days. So we had a team at 6th Street in Asia, a team at 6th Street in the US, a team at 6th Street in Europe, literally working.
Handing off the work.
Really handing off the work.
That's cool.
There wasn't a vaccine or anything. So our view is, for us, it was as much about the fundamentals of the business as it was how much liquidity runway can they have? And we had to make the bet with that liquidity runway that something, there would be a cure, something would get better. And basically it gave them, and they obviously had a lot of leverage to manage the business, but it gave them up to 4 or 5 years of liquidity. And our whole thing was if we go to 4 or 5, if we go to
We got
four,
bigger problems.
if we go to 3 years of this, like, by the way, this led to another theme on sports and live entertainment because we learned that we like experiences, like humans like experiences. But that was our analysis. So the fundamental business analysis, make sure everything in the unit economics were what we thought. Obviously, the team, making sure that the management team and the CEO were what we thought. But the other thing, it was really a liquidity analysis, and then making that sort of, not in the spreadsheet judgment, which sometimes you have to do. That was as much of a risk unit as anything, is like the liquidity analysis to make sure that, how much runway do they have.
Do you try typically to boil things down to a simple bet like that so that you understand it in simple terms and you're not like creating too much complexity where it doesn't?
Well, we like complex things, but in terms of like the ultimate call, I mean, we do all the fundamental analysis, but ultimately investments come down to 3 or 4 or 5 things. And we try to figure out, I wouldn't say we simplify the overall investment, but we try to simplify what are the 3 or 4 or 5 things that matter. And we know those things inside out. We also understand, and this is the other thing investors do, people only think about sort of explicit risks. They don't think about implicit risk. So we always try to put that lens on it. What are the implicit risks that we're assuming away? One of them in the case of Airbnb was like, we're assuming away that there will be a cure. We can't all be locked in our houses forever. We were willing to take that risk, but we had to think about that because that was part of the investment. But ultimately, it comes down to 3 or 4 or 5 things. So I'd say yes, simplify things, but it's really always comes down to those 3 to 5 things.
When you think about what success means for the whole firm from a return and risk standpoint, how do you think about it? Like, is the ultimate comparable for units of risk and return like the S&P 500 or something? Like, what is there an explicit goal of like, we exist to beat this thing or provide our investors with something more than this?
Look, our investors have expectations, but ultimately we're an absolute return investor. But sometime, if you just take an extreme example, let's say that every single asset class is flooded with liquidity. Maybe that's not the right time to invest. And sometimes the best thing you can do as an investor is not invest. But in terms of like returns, it really depends on the level of risk units. Sometimes like in 2017, we saw 20%, 15 to 20% deals, but the risk was too far out on the risk spectrum. So we said, listen, we're going to accept that's too much risk for, even though that return is there. And some people kept doing that. And by the way, some of it worked out well until COVID. But we try to literally think about, again, the environment that we're in and what things are giving us. And obviously, also our investors have, a set of criteria for each fund that we try to meet that expectation as well.
I'm very intrigued by the fact that some of the great go anywhere investors gravitate towards sports at some point. Talk about the Real Madrid, FC Barcelona transactions, what you're doing, why you're involved in what you like about that space.
And this is a theme coming off of COVID, live experience, sports and live experiences. So 2020, we obviously know what happened, but a lot of the investments in sport teams, you weren't actually able to do as an institution. So once COVID happened and all these big franchises, their revenues went to zero. Like people weren't going to games. They still had some of their media deals, but it went to zero. So for the first time ever, they started to reach out to institutional partners. Our whole thesis in sports is the biggest global brands in the world. And our whole thesis in sports, and we can talk about live entertainment, is that these are historically local brands. And because of technology, because you can be on your phone and you can actually watch anywhere in the world. You can be a Dallas Cowboy fan in Australia and watch, or Real Madrid fan in China and watch. That whole local to global, that was our thesis. So we literally just started, through our relationships, calling on the top global sports franchises in the world. Now we've got San Francisco Giants. We're partnering with the Dallas Cowboys and New York Yankees. The biggest brands in the world, FC Barcelona and Real Madrid, we started calling them, building relationships. I mean, the deal with Real Madrid was they wanted to do business with us, and we wanted to do business with them. And it was literally, again, a whiteboarding exercise. That structure we did with Real Madrid, where we basically formed a joint venture with them or partner with them on their stadium renovation, which is the Bernabeu.
Yeah.
So that was
the use of funds.
That was the use of funds, but we formed like a company that sort of owned the stadium assets. But that was all, again, a whiteboarding exercise. When they came to us, they had an idea, we had an idea, and it was literally multiple whiteboard sessions to come up with that structure. And now that structure, a number of people have tried to deploy that structure elsewhere. FC Barcelona, again, because of COVID, it impacted their financials. They needed to do something. Joan Laporta, again, Joan Laporta, incredible human as well, by the way, as well as Florentino, two people I've become friends with through the Real Madrid and FC Barcelona process. They were trying to pull levers to basically be able to keep their roster together because their view was, if we lose our roster, during, like key components of the roster, we won't be able to stay competitive. And you can see how they've done since then. That's sort of how those deals came about.
So if you think about like the stadium one as an example, there's this interesting push and pull. Like they know the money they need and for what. They're probably optimizing for, giving up the lease or finding great partners or whatever. And there's some minimum return that you need to get interested. What is that like push and pull process like at the whiteboard? How do you communicate to them like, this is what these are the things that we need to get there?
First of all, what are they trying to solve?
Yeah.
What structures? They didn't want to do debt, so we had to do effectively an equity joint venture with them. So we come up with solutions. We price those solutions. We say, look, here's option A, here's option B, here's option C. They say, we kind of like a combination of option A and option B. We're like, okay, we go back to the drawing board, we come back and we say, here's a hybrid of option A and option B, which is kind of what happened on that deal.
What are those levers? Like in those different options, like what are the key levers?
For every deal, they're different. There's, if it's an equity deal, obviously price. If it's a hybrid deal where it's a convertible deal, there's a yield component and a strike component. If it's just a private credit deal, it's just a yield component. Sometimes when we're doing joint venture, we're like, what are the value added operations? In that case, where one of our portfolio companies, Legends, is providing services to them that is helping them uplift their premium offering within the stadium. So we underwrote that and put our money where our mouth was on that. So in each deal, the levers are different. And that's the thing. It's a whiteboard because every deal, we've got a toolkit, which we've been using for 25 plus years, but we feel like we can price anything that's not binary, stroke of the pen risk. And then it's gotta work for them. Or if it doesn't work for them, we go back to the drawing board and try to construct something that does work for them. But again, in all these deals, you see it's like where it all takes place is the whiteboard, and it's not what we initially proposed to them or what they initially proposed. It's that sort of partnership with CEOs and management teams.
So in this case, there's a stadium that's mapped onto a bigger organization that produces lots of revenue and has lots of streams of revenue, et cetera. Are you always kind of looking through to some underlying holistic whole thing and figuring out how the joint venture that you own equity in benefit? Because the stadium by itself is just a thing. So the ticket sales or something and the revenue associated with the stadium itself, it becomes the thing that the joint venture.
Yeah. So in that case, you got premium VIP suites. You have food and beverage, but premium offerings. You have a museum. Like if you ever go to the Bernabeu, there's an incredible museum of all the history.
Yeah.
It's the premium tickets. But in all these deals, there's different levers depending on what it is. In this case, it's a perimeter of assets, but it could be the whole company.
Yeah,
we did the Affirm, Max Levchin's company. We did a $20 billion partnership with them where we formed a joint venture with them so they could originate more assets and have more operating leverage. So that one, again, my partner, Michael Dryden, who runs our asset-based finance business, has known Max a long time, gets on a whiteboard, they start mapping it up. It's not like you can pull it off the shelf. I mean, most of our deals, you can't just pull off a shelf. It's right brain. That's why when I say one of our core principles, that independent thinking, stay away from the group think, just think differently.
What is the process by which you develop the 15 to 20 themes at any given point in time?
At any one time, we have 50 to 60 themes bubbling through 6th Street. Because remember, we have 10 investment platforms.
Sure.
They
each have a couple.
They each have 5. So they're constantly bubbling. And then from that, there's really good themes, but they're not actionable. A good theme is it's got to be actionable. So we sort of narrowed down to 15 to 25 themes. Where those come from, it's from sector knowledge. We have 16 different sector franchises. So each of those sectors is doing primary research about their ecosystems, thinking about not only what does that ecosystem look like today, but what's it going to look like tomorrow. So there's research. Some of it's, we've got a whole bunch of longstanding relationships with CEOs and management teams, and they'll call, say, hey, we're seeing this in our sector, we're seeing this in our business, or we're seeing this. So, hey, that's interesting. Let's sort of follow it up. Sometimes we're looking at a company and investing in a company, and we're looking at, that's an okay business. And then we look at the supplier to that company, like, wow, that's actually, the supplier is actually more interesting than the company we're looking at, or we're looking at a company and one of the customers is more interested. And then the last thing is just sometimes like all of a sudden you start to see like 3 deals, like data centers. You start to see that and you're like, what's obviously that's not a good example because we started doing data centers back in 2017 with AirTrunk, which we can talk about because that's a company we literally started the white sheet of paper, which is actually just got bought Blackstone for I think $16 billion or something like that. So it comes top down, bottom up, and sometimes we just have a view on something and we'll start doing a bunch of primary research. But a lot of it's through primary research, through relationships, but it comes from everywhere. It's not one place, it's everywhere. And that's the whole point of our firm, is that because there's no silos and no fiefdoms, all those things get circulating up. All of a sudden we see a theme from our power people. We have a team that all they do is power. Our data comms people, data communications, and we see a comm from our real estate people. And this is kind of just what's going on with AI, the constraint of power, putting all those on one umbrella. I'm like, hey, let's have you guys all work together on this.
What are your favorite 2 or 3 themes right now? The ones that personally animate you the most?
I mean, we have 25 themes running through the platform right now. So I'll just give you a few of them. Number one is, partnering with big companies, big corporates to help advance their business. So a firm, we talked about, thinking about partnering with asset originators and banks to basically help their origination, help their operating leverage. So I'd say that's a big thing in our asset-based finance business. Our real estate business, just again, the idea of people getting older, wealth tech. So we talked about the wealth space. Again, the percentage of wealth, of private alternatives in wealth, it's going to go up. There's a whole bunch of services and technology around it. So I'd say wealth tech is one. Sports and live entertainment, we talked about the sports piece, but again, live entertainment, the one thing we learned during COVID is that people like experiences, they value experiences more. As you know, from the younger generations, I know from my kids, they could care less about material things. They just want experiences. So that is a big theme for us, and you'll continue to see us do more than that. But those are the bigger ones.
Given how big this has all become, assets, number of people, strategies, investments, how do you spend your own time on individual investments versus on people and on teams? Because obviously you love investing, the investment by investment level detail, but there's way too much for you to keep in your head at any one point in time. So what does your week look like?
My partners that run the 10 different investment platforms, they're great investors. They're great investors. They're just being on, when we first started the firm and investment committee, I was very vocal, probably 20, 30% of the conversation, again, maybe even in some cases more than that. And each year that's gone by, people just keep growing. And again, these are great investors. And I just less and less. And to the point now in investment committee, I have views, I have things, but it's very rare where there's some issue or something we're thinking about or some way to create value in a particular company where through the course of all the conversation investment committee, I can just sit there because everything that I would have said or would have asked has already been asked, in a lot of cases asked better than I would have asked. And I'm on all the investment committees or on the big investment committee. Some of the smaller deals I don't get involved with. But again, I'm sitting there just watching my partners, just listening. I'm watching I'm watching David Vineyard. It's kind of what David Vineyard used to do. It's watching a tennis match. And again, not only listening to the partners, but also some of the junior people or mid-level people, because sometimes the best ideas come from them. I'll get involved with 1 or 2 deals a year. Like a deal like Airbnb, I was the the front person, deal like Real Madrid with, my partner, Rich Berlotti, I'll get involved with. So some of the deals, like the bigger deals, I'll step in and get actively involved. But in general, we have a great team, not only with the partners, but the next generation. In terms of running the business, obviously, I think a lot about our strategic plan and executing the core strategic priorities. So I try to think about big boulders, and there's, 5 big boulders. I'm always, generally very related to our strategic plan. I'm maniacally focused on that. I got a lot of excessive amount of energy, as you might be able to tell. What I try to do is, first and foremost, is keep the culture. Because without our culture, we don't have our culture's everything. We don't have our investing business. So if I see something not working the way it is, or some deal doesn't get passed to another group, or some relationship doesn't do that in an unfettered way, like it's so counterculture to like hive relationships, or not call people back, or not help people, even though it's a deal not related to your particular sector. I'm trying to make that very counterculture. If I see people like, not acting, which doesn't happen a lot, like with ego, which doesn't happen, or something that's like not a team way, I'll pull them aside and I'll be like, that's not how we do it here. And I'm like maniacal about that, because again, it's not just culture and abstract, it's how we actually execute our business model and deliver great outcomes for LPs. And then the last thing I try to do is what I call toggle like a hawk. So I got the right people in the right seats. They bought into the culture. They're good investors. They're good managers and leaders. They know what we're doing. They know what we're trying to solve. They're willing to work with other groups. We have really good reporting. So that's one thing I learned at Goldman, is like just reporting, like just like communication, and not fancy reporting. So I always know what's going on. And then obviously I talk to probably 20 or 30 people a day throughout the firm. My average conversation is probably 2 or 3 minutes, but I literally talk to people all day, all the time, just to figure out what's going on. And if there's ever a situation where I need to go 10,000 feet deep, I'll go 10,000 feet deep, but then I try to go back up so I can just see everything that's going on. Because if I'm 10,000 feet deep every day, I'm not doing my job. And that's kind of how I think about it. But those are really how I spend my time. But the reality is we have great set of partners. A lot of the partners, we've worked together for 20 plus years. We have shared values, like first principles on doing business the right way. So a lot of those first principles are already in place because we've worked together for so long. We all know what we're doing, and we all kind of buy into the mission of what we're trying to do. And again, for me, keeping the culture the way it is and making those type of behaviors, life is too short, that's one of the things I just try to protect that with everything.
All these fascinating stats that are coming out. Apollo put out that stat about the percent of companies north of 100 million of revenue that are private is like 93% or something like that. It just seems like the private markets, and let's say the allocation of an average high net worth, wealth advisor client or something is 3%, and it's going to 30% or whatever. Maybe they overshoot, and that's the problem, and then they have a liquidity crisis, and that's the problem. But I'm just curious for your commentary on, it's amazing to me how few net new pure public equity investors I interview. Like it's kind of a dying breed.
Well, it's kind of ironic when you step back and think about it. You basically have all these public companies. It's all going, there's less public companies. It's going more private. But now you have all these trends of people trying to take ETFs on private companies. So it's almost like it's a little bit circular. It's a little bit circular.
Yeah.
It's a little bit circular, but that's really interesting when you start thinking about ETFs, and now there's going to be trading, private capital. You start to see all this. So all this stuff is a little bit circular, but it's a real dynamic. And I think it's something that anyone that's thinking about investing and thinking about capital allocation needs to, take real note of, these dynamics, because they're real dynamics. And by the way, I think for some of the traditional sovereign wealth funds and pension funds, they've had sort of unfettered access to GPs. And I think that they've got more competition coming in from the wealth channel and insurance channel. So it's going to be interesting to see how all that plays out.
I think like anything, the very best GPs are a lot better than the average ones. Just as the way the best companies are a lot better than the average ones. It's an interesting point that they
Who the fuck you talking to? You know, everyone has an opinion. I'm sure FDA wants to talk tough, and Sarepta wants to talk tough, and it's just a. Rest in peace. Well, a joke's a joke till you get your jaw broke. It's something you're gonna have to learn. You might as well learn it here. Take it as a lesson. You know what else I find funny? I find banning people funny. I get tilted like crazy. Me do something, man. And people are getting hit for no reason. Hit, and not even breathing. That thing barking. China. Strays are real.
they may have to compete. The best LPs will have to compete for the best GPs in the same way the GPs do for companies.
It's starting to happen. I mean, you're starting to see with some of the larger LPs that are the traditional sovereign wealth funds or pension fund, they're looking for access. They're looking for access because they're worried about access in the future because they see what's happening. They see, all this wealth capital coming in. I mean, there's not an earnings call where people aren't talking about sort of the growth of the wealth channel and how much money they're raising in the wealth channel, obviously seeing the insurance. So I think access to your best GPs, those conversations are accelerating because, again, ultimately, everything's a choice of alternatives. And I think that dynamic is the other part of this.
In addition to the beautiful get over yourself, people that are over themselves, Spurs idea, are there other outside sources of inspiration that have really fueled your thinking? People, mentors, icons like Popovich, anyone else that has really cemented the way you view the world that we haven't talked about?
When I got to Goldman Sachs, I met Jody on the airplane and I showed up to Goldman Sachs. I didn't know anything about finance. And, I remember going to the first, analyst session with all these super smart kids and, from the best schools, all 4.0s and, just super intimidating. And I had something very fortunate and also one of the most impactful things in my professional career happen is that when we first started, there was a bank called Amoresco in Dallas, Texas, and they were failing and they needed to raise liquidity. So I got tasked to basically lead the evaluation of buying a portfolio of loans from a group called RTV Ventures. RTV Ventures, so as part of Amoresco, is basically a bunch of loans to radio and TV companies. And back then, this is before direct lending or private credit, it was because there was a lot of asset value to the radio stations and TV stations, but they had no cash flow. A traditional bank couldn't finance them. So what these guys had done, this is a little pocket in this big bank called Amoresco. They basically had gone out and given these companies first lien loans at 15% coupons and warrants for 10 to 30% of the company, which was, you can imagine it's breaking my brain. And they called it, stick value, but they would take a radio station, a TV station where the stick value, and these things traded, they were sold all the time of say $200 million, and they would lend the first $50 million. So from their perspective, going back to sort of risk units, they were the first 25% of the value of the company in a first lien loan, which at the time it kind of broke my brain. And the guy who ran that was a guy named Stephen Plus. And Stephen Plus, who's now Sixth Street's chief risk officer, he's about 15 years older than me. We ended up buying the portfolio, and it's about $400 million portfolio. And I was basically in charge of the portfolio. And Stephen is this slow-talking Texas guy who you meet him and you're like, this guy, is he going to get out the sentence or not? But he's one of the smartest guys out there. And the fact I got a job at Goldman Sachs is just pretty lucky. And he basically for a year and really 2 years taught me finance, taught me investing, taught me about risk units, taught me everything, taught me about how to go through documents. And literally I look back to it now. He was 15 years older than me. Here's some kid comes down from, even though I was Texan, I was coming down from a New York firm. Now I still had a little bit of my Southern accent back then, which got beat out of me by all my friends in college. And, and here's this guy literally answering every week, every day, 500, just question after question. I used to have these yellow notepads like this, but they were bigger. And I literally would write down my 10 questions for Stephen Plus for the day, and I'd literally call him and ask him. And literally that whole process of him teaching me about investing and how to think about risk, how to think about return, and just all that, it literally led to what made my career, the start of my career at Goldman, where I started running businesses when I was 25 years old. Because that whole idea with Stephen is, from that, I started to say, wait a second, I know these are really high rates of return. And when I started to actually understand what it was, but couldn't you sort of take other businesses that are good businesses that banks, for whatever reason, won't lend to because they've got a very specific credit box and still earn, a good return, but not that high, and then have a much bigger TAM? And could you do that in the middle market? And I technically wrote it, but Stephen helped me write it. I wrote a business plan when I was like 23 or 24 years old. And that business plan was basically to do middle market direct lending, which at the time Goldman Sachs had never done.
Yeah.
First of all, direct lending didn't exist. It wasn't a word. And Goldman Sachs had never done anything in the middle market. And that's when, by the way, this is when I first met David Vignier. But I just said, look, this could be new clients for Goldman. This could be, again, we could go out, instead of earning on that portfolio, they were like 30% returns on first lien. Maybe it's like 10 to 12% or 13 or 8, something less than that. But again, doing something outside a credit box, but on good assets or good businesses. And that business at 24 years old, I went to present to Hank Paulson, Lloyd Blankfein, David Vayner, the executive committee. And that was the first time that Goldman ever got in the middle market, is through that. By the way, that business is now, I think it's over, Julian Salisbury, one of my partners, told me it's over $50 billion now.
Wow.
But it all happened because this guy, Stephen Plus, took the time, answered all those questions. Would have never happened. And by the way, most people in that situation would have, here's some kid coming down. By the way, and that just taught me about developing people. And that taught me the importance of developing, because I saw what happened to me, and that's why we put so much emphasis on developing the younger generation. Age is just a number. It's like, get people that buy into the culture, work hard, that are intellectually curious, ask questions. But that whole thing, and then that really changed everything. But it really taught me a commitment to developing. I mean, some of the, a couple of my partners, Borna Mogbel and Matt Dillard, they were associates when they joined Sixth Street on the first day, and I've been working with them every day since, and I love doing it. It just taught me to do that, and we try to do that across Sixth Street. And by the way, today, whenever there's someone who I think at Sixth Street, and people know there are, that I feel like needs development or could be better at reaching the potential, guess who I have him work with? Stephen Plus.
Pretty amazing.
It's incredible, but that was one of the most selfless acts, and it changed my life.
My friend Ravi Gupta has my favorite framework for this development concept, which is demanding and supportive, is like the orientation he wants to have towards people. How do you think about the framework for developing people and talent?
That guy's a smart guy.
Yes.
That podcast he did with him, I had like 20 people. I thought that was a great one. He's super talented. Look, for me, it starts with caring. You have to authentically care for that person, and you have to authentically care for their development. Like, to me, like, that's 1, 2, 3. And what I always tell, all our leaders all the time is like, first of all, you got to care, and you got to be proactively, as part of your day and part of your week and part of your month, thinking about, how do I develop this person? What are their strengths? What are their weaknesses? How do we do that? And by the way, that's why we have this personal business plan that we make everyone do. But it's not only that we have everyone in the firm do it. Part of the process is not only having them do it, but the other part of the process is having them go to their leaders and really sit down with them to sort of identify that. So for me, it's like being intentional. It's being deliberate, but you got to have a plan, because you can't do it in an abstract. You got to be very explicit. And the way I think about the personal business plans is, every year you have a personal business plan. The format of everyone's personal business plan is the same. The content's different. You have 5 things or 3 things on your list you need to improve. You knock down 70% of them. That's part of your toolkit. You leave the ones that you didn't knock down for the next year. Those go to the next year, and then you add 2 more. You do that for 20 years. You're going to have and you're deliberate about it, and you keep notes like you do on the yellow notepad, and you're intentional about it. Those people, by the time they get to 20, they're going to be optimizing their return on time, because they've got such a wide toolkit to go through. And by the way, the corollary to that is, allows them to spend more quality time with their family and their kids. I think oftentimes people try to skip steps, and the whole purpose of these personal business plans is the intentionality to really knock them off and be deliberate. But it's not just, you're not on an island, you're in partnership with whoever your leader of that particular investment platform is. And that's how we think about it. We literally run that process over and over. And again, we say, look, shoot high, because if you're doing 100% of your plan of what you're trying to work on, you're probably not aiming high enough, but try to knock down 75% and keep adding to it. And you'll wake up one day and your future self will thank you because you get to spend more time with your kids and go to all their sports games like I do today.
Is the retention like crazy high at 6th Street?
We've never lost a partner at 6th Street.
Crazy.
Never lost a partner.
And think that's all culture.
Maybe after this podcast we will, but because you got so many listeners. But and you could argue, maybe we should have lost some. Maybe there's a criticism there, but we just try to make it an environment. There's different forms of compensation. I think sometimes in our industry, everyone thinks about one form of compensation, which is monetary, but we always talk about there's like who you work with compensation. There's like what's your culture like compensation. There's like, are you getting developed compensation? There's opportunity. Do you have sort of white space in front of you compensation? We try to take a more holistic view to that, and we coach that. And look, people like to work there, and we don't have assholes. We don't tolerate it. Will that pop up every once in a while where someone gets real, two people get intense in a district? That happens as long as it's like with respect and dignity. And again, people get intense, but that's not what we're doing, because again, our business model is predicated on people working together, not having fiefdoms and silos. So they all work together, share information, share relationships. That's our business model. I mean, that is literally the essence of our business model. So that's why we're so focused on it.
Say more about this concept of future self.
When I grew up, I was very fortunate that my parents, we didn't grow up with a lot, but they always spent a lot of time with me.
Yeah.
They were always present at all my sports games. They were just always there. So, when I started, working at Goldman, I had that in my mind vividly in my mind. It's like whenever I had kids, I didn't know when, I wanted to be able to be very present with them. And my idea was, and it goes back to those yellow piece of paper, is that if I build the biggest toolkit possible, if I invest all the time now, prior to when I have kids and a family and a wife, that I will be able to spend maximum time with them. So I had a bunch of motivations. There's a bunch, but that was one of the things, is like I was always thinking about my future self, not from a business perspective or career perspective, but that I could spend more time with my kids. Whenever these kids don't exist, by the way. So this is just like a future self. And my idea was like, it's all about return on time, because investing is overwhelming. You could literally spend, there's so much, it never ends. There's like, you could spend all day on, half a deal. Like it never ends. So my idea is like, I need to be able to be the most efficient at return on time. The way I want to be efficient at return on time is sift through, know what you like, have the biggest toolkit possible. And I got to build that toolkit as much as possible. That's why I started doing my own personal business plans when I was, just starting the business. But it was always with the mindset of my future self, so that when I got to that point, I could be a good husband, be a good dad, and be present like my parents were. So that's why whenever I talk to, our incoming associates or, new people at the firm, I always talk about, it's like, think about your future self. Like, yeah, go have fun. You got to have fun, but the more time you put in now, when you don't have, a spouse and kids, you're going to basically set yourself up where you can spend more time. I think some people, mortgage the future by having, again, you got to have fun, but too much fun where you could have a little bit less fun and spend more time building your toolkit so you could spend more time with your family when it happened. And that was kind of always a motivation for why I was so focused on those yellow notepads and just that future self and that moment. Again, just to be clear, because I have friends probably listen, just to be clear, I did have fun, but I was also like thinking ahead about that future self.
If I apply future self to 6th Street, to the whole thing, and you think 5-10 years hence, something like that, what do you hope it becomes that it is not yet?
I want us to stay an investor-first firm. I don't care. Other people in the industry want to be deployment factories. By the way, there's nothing wrong with that. All good. But that's not what we want 6th Street to be. That's number one. Number two is culture is everything. To me, there's two tests I'm going to always run. One test is that we have an offsite every year in Austin, Texas, where the whole firm comes. And I go walk around, I meet a bunch of people, and I'm like, did I meet any a-holes? Did I meet people that, don't ask questions or just talk about themselves. And so far, we're undefeated. We're like 16-0. But the other test I'm going to run is when I'm an old man and 80 years old, and I come back in the firm and I sit in a random investment committee or a random meeting, like, is that still true? And to me, that's the ultimate test. And would I introduce the people then to my family, to my grandkids or my kids? Because that's the ultimate test. Like, that's a test. And we always talk about that when we're interviewing people. Like, would you, first of all, are they over themselves yet? Okay, which again, in our industry, there's a lot of people not over themselves yet. Maybe they'll listen to this and get over themselves. That's a whole other topic. But also, like, would you introduce them to a family member? And that to me is more important than anything, is like maintaining that, and wherever that journey takes us, that's where it will take us. But again, for our business, we're an investing business. Those things are what make up us trying to drive what we believe fundamentally, religiously, because we've been doing it for 25 plus years, great outcomes for our LPs. And if we can do that, and ultimately you serve your customer, which in our case is our LPs, our people, we do all those things, that's where it will take us. To be clear, we have 5-year strategic plans and very specific objectives, but that's what I think about on the horizon. And I've shared that, like I said, I've shared that broadly with our entire firm because it's how I think about it.
My friend Boyd Vardy has this great phrase, which is, we don't know where we're going, but we know how to get there.
Yeah, I like that. I like that.
Which sounds a little bit
And you
like
got to be able to adapt because, think about like software engineers. Like every mom and dad in Palo Alto, 3 years ago was telling their kids they had to do software engineers, and now none of them tell them not to do software. Things can change, and you got to be adaptive. And we're headed into, we're heading into interesting times here.
Yeah. Well, I'm fascinated by what you've built. It's so interesting and fun to hear all about it, its history and its unique aspects and where it's led you. It's such a fantastic conversation. When I do these, I end with the same traditional closing question for everyone. What is the kindest thing that anyone's ever done for you?
I think I'm gonna have to say the Stephen Plus, just being 15 years older than me, taking time to answer all my questions. By the way, in a lot of firms, I think they would have gone around me and said, "Hey, what are you doing?" And he took the opposite approach. And that's the kindest thing anyone's ever done for me, and probably the most impactful. I wouldn't be where I am today without him.
Amazing. Thank you so much for your time.
Thank you.
What's up, people? Almost 4 o'clock. You ready to smoke some weed? I know everybody's out there smoking. Don't lie to me.
It's that real shit, yo.
Butterfly in the sky.
Come on!
I can go twice as high.
Let's get it on.
Take a look.
Nigga.
In a book.
My nigga.
Reading rainbow.
You think it's a game?
I can go anywhere.
Suck my dick.
Friends to know.
My nigga.
Ways to grow.
Nigga.
Reading rainbow.
Here we go again.
I can be anything.
Same old shit. What?
Take a look.
Nigga.
In a book.
My nigga.
Reading rainbow.
See, this is the shit I be talking about. You think it's a game? You think it's a fucking game? What I really want? What I really want? Bad or die. Talk is cheap, motherfucker.
So I printed the lyrics of Rudolph the Red-Nosed Reindeer, and
I know the lyrics.
Would you do us the honors of spitting Rudolph the Red-Nosed Reindeer?
You know Dasher and Dancer and Prancer and Vixen, Comet and Cupid and Donner and Blitzen. But do you recall the most famous reindeer of all? Come on! Rudolph the red-nosed reindeer had a very shiny nose. And if you ever saw him, you would even say it close. Come on, come on! All of the other reindeer used to laugh and call him names. They never let poor Rudolph join in any reindeer games. Then one foggy Christmas Eve, Santa came to say, come on, Rudolph, with your nose so bright, won't you ride my sleigh tonight? Then all the reindeers loved him, and they shouted out with glee, Rudolph the red-nosed reindeer, you go down in history forever. You go down in history forever. You go down in history. What?
That is gonna be fun. I'm so excited. I'm so excited.
What? Come on.
Shut the fuck up.
I can do anything. Take a look. It's in a book. Reading Rainbow. Reading Rainbow. To normalize audio. Some of these are a lot louder than others.
Wrong. Wrong.
Quiet, quiet.
Okay.
I love it. Quiet, quiet.
Wrong.
Real talk. You gotta be ashamed of yourself. Old as you is.
Damn, son, where'd you find this?
Stop. Take lives. What do you mean by that?
235 acres. We farming our own chickens, homie. Thousands of chickens, thousands. Running around everywhere, quack, quack, quack.
Probably don't want this Nigerian news, although it looks interesting. I'm going to disable it for now just because Nigerian news, local Nigerian news. I mean, I'm not trading Nigeria at the moment, so I'm going to just avoid that for now, you know. You can get this news terminal for free on Godel. Let's go to godelterminal.com. Texas Instruments beats earnings. So Texas is trading real quick. Looks like it's down 8% for now. Streaming news, you see it first. Google's tomorrow, right? Oh, Kyle, 3 news sources max. Try 8,000. We have 100 times the news of TradingView on your average news ticker. So if you care about real stuff, things that actually move stocks instead of little lines on a chart, use Godel. Why would you ever use a place where you have to click to get the news? You have to go through ads to get the news. This is crazy. Who would do that? I know, Kyle. Crazy. We're twice as much news per ticker than Bloomberg. And it's not even close with the other web platforms. I mean, look at the news that appears before your eyes. Teenage guilty of manslaughter and stabbing of 16-year-old Halifax student. It's so complete. You get everything. No pun intended. Oh, we're going to add that back, Spencer. We used to have the AI reading the news. Oh, news terminal's free. I think what we might do to punish the free users is make it so that they can't, Rigetti to announce. Rigetti, okay, yeah, all the press releases just came out, it's 4:05. Rigetti to report on the 5th. Oh no, the 12th. When you work on Wall Street over the years, you get an eye for watching the tape. I saw that right away. I don't think we would delay it. Maybe delay it 30 seconds or 10 seconds. Abivax out. Positive phase 3 results from both studies. Oh boy. We missed this one. We wanted to get this binary too. See if we can buy some. Let's see what the data looks like first. 16% placebo-adjusted remission rate, individually 50 mg. It's pretty good to me. Data, let's see. 25 mgs, clinical remission 2%, 23, 24, very good data. Here, 25 mg fails in ABTEC 2, but still directionally good. Week 9, totality of the data is quite good here. Week 8 here, another weird result here in ABTEC 2. Man, this is good data. I think you buy this. If you can. I don't know how to look at this thing is. Abivax. Is it halted? It must be halted, right? Stock is halted. Good data. Amazon acquires Bee, maker of wearable AI assistant. Huh. Well, good. Congrats to Abivax. I don't think I was going to ever get too bullish on that. It had some good parts, some bad parts. Yeah, congrats to anybody who went long. If you went short, rest in peace. Internet of Things. What are you asking me, Jonathan? Yeah, anybody who bought at Abivax is going to be very happy. Intuitive Beats. Check out some of these prices. Intuitive down 6%. Texas Instruments down 6%. Yeah, only 5 binaries left. Yeah, they got so lucky with that drug, Abivax. Wasn't that an HIV drug at some point? Yeah, news portal gets Fannie and Freddie. Try it out. It's free. Go to godelterminal.com, app.godelterminal.com. When you're prompted for a credit card, just hit X. It's my secret. Just hit X. Say no thank you. Click. Click. I ain't paying that. Click. Oh, they did COVID too? It's supposed to be an antiviral? What if you have HIV? What if you have HIV and Crohn's? Or was it UC? This goes to show you, right? Never know what a random hydrocarbon drug-like molecule will be good for. International's coming very soon. We will punish the free users. Well, as we amplify and grow the platform, we are going to have to make the free user experience not as good as the paid user experience, but it's still going to be better than any damn platform out there. Well, 5 or 6 more binaries left in the next month or two. Well, John, there's a lot of them. You want to see one of them? Let's say I'm researching AstraZeneca, AZN, right? Read the news, okay, this and that. And I do RES for research for AstraZeneca in here. What's that? A report from JP Morgan and Barclays? Oh, let me read that. Oh, look at that. You can't lock in $80 a month. We're going to raise price. And Selamimab fails to meet primary endpoint. Called my homie Zain up. Zain Ibrahim. Go back, okay, JP Morgan had some interesting report there. Let me read Barclays' report. Wow. Islamic Jihad says it has lost contact with group holding hostage over Israeli attacks. I definitely want to come to Saudi Arabia. Marhaba, Habibi. Alhamdulillah. SAP? Is SAP out? Yeah, you should be able to chart market cap. We don't have that yet, but actually one of our boys could do this. Hey, hey. What do you think about working on charting market cap? Nathan. What do you think? Yeah, what do you think about working on a feature where you can chart market cap?
Chart market cap. Wait, that'd be so nice, but how would
You just need shares.
DM you about historical market cap data, but you
It's not hard. Yeah, no. All you need is historical price and shares outstanding.
Do we have that?
Yeah.
Okay.
I'll help you with it. Yes, do NI, FNMA, or NI. Better to even do NI Fanny. Oh, that's nice. A lot of news there. Yeah, we need to get OTC prices. Is OTC coming with international? I think so. Yeah, Thinkorswim basically doesn't have any news. Sure. If we don't have that already, SVH, that should be on DES maybe. But yeah. Fanny's been such a winner. All my smart friends have been long it. Yeah, Patchy. International's done. They're just QAing it and making sure it's perfect. I've tried it. It's pretty good. Probably next week. It's very solid. But international roll out in phases. Like it'll start. It's going to be every country. But prices, fundamentals, earnings, those will roll out sort of separately. So it starts with prices. Hey guys, does India come with international? Yes, India comes with international. I can't wait. I'm gonna have to learn Hindi. Habibi. Listen, if you're not an institutional investor, high net worth, don't bother getting Godel. It's going to be too expensive. You won't be able to afford it. This is for top tier investors only. If you're struggling to afford TradingView, just go watch Meet Kevin, man. You don't need me. Go to Meet Kevin. Go to Amit. Don't worry about me. Yeah, if you're a brokey, yeah, get out of here. Go use Google Finance. Go. Close the window. Hit the X button. Get out of here. Go meet Kevin. Yes. How much should... Fucking loco, bro. What the fuck is wrong with you, Holmes? Fucking loco, bro. Is there such thing? Rich Albanian parents. I didn't know there was such a thing. Don't troll me, bro. I'm not the fucking one. Trolling me. I work hard for this shit. Alejandro's dead. He's locked in my basement. $1. D-Wave's going to $1. $1. Yeah, we can do a graph B. I don't understand what you're asking. Under mask. Yeah. Not a big cannabis fan over here. You can get Arabic news and in the terminal as well. All right, guys, I gotta go do some meetings and stuff. I will see you when I see you, which means probably tomorrow. And yeah, have fun, stay safe. Thank you for everything.